Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman. That's Brad Smith. And here are the three things that you need to know to get your morning started. Thing number one, Target numbers last quarter hit the mark, but earnings this quarter will miss the bullseye. Comparable sales almost flatlined in Q1, while digital sales slumped by 3.4% from a year ago. A growing issue for Target and other retailers, in-store theft, which Target CEO Brian Cornell said could trim profit this year by $500 million. Still, the company did leave its full-year earnings forecast unchanged. And there is a pattern emerging from some of these early retailers that consumers are being more selective in their purchases, avoiding bigger ticket items. It follows on what we saw with Home Depot's report yesterday. Thing number two, debt ceiling negotiations are inching forward, even as the threat of default continues to hang over the market, particularly and increasingly the bond market. The debt ceiling impasse continues to act as a sword of Damocles hanging over the market. President Joe Biden and Kevin McCarthy have appointed high-level representatives to try to push talks forward and wrangle over details. The president nixed a visit to Australia and Papua New Guinea that was to follow his trip to Japan for the Group of Seven meeting in order to return to Washington to continue negotiating. Treasury Secretary Janet Yellen, of course, has been warning over the issue on what seems like a daily basis. She says a default could trigger recession. And thing number three, the world's richest man making a series of headlines overnight. We're talking about Elon Musk, of course, addressing shareholders first at Tesla's annual shareholder meeting in Austin, Texas. Among the highlights, he announced the delivery of the much-anticipated Cybertruck. He says that will begin this year, adding he'll be driving one himself. His tone on the economy was downbeat, but he said Tesla was well-positioned, and he said the Model Y will become the best-selling car on the planet. Musk also hinting that Tesla might rethink its stance on advertising. That would be a big shift. In a separate interview with CNBC, Musk touched on monetary policy, defended his tweeting, and slammed work-from-home culture. Well, let's get more on thing number one. Target out with a beat on earnings in its latest quarter. However, its outlook missed the bullseye. This comes amid continued softness in discretionary categories as consumers face elevated inflation in a sluggish economy. Joining us here to discuss Yahoo Finance's executive editor, Brian Sozzi, and you were on a call with the company last night where they talked about these numbers. So as we look at the sort of through line from Home Depot to Target, it does seem like there is this theme emerging of overall consumer softness.
Yeah, I think you have to split this quarter in half from Target. So Target came out here, I would say posted its second consecutive comeback quarter. Not exactly a great quarter for Target. Keep in mind, 2022, the story with Target is it was horrific earnings misses, bloated inventory. It looks like they've gotten some of those things under control. Gross margins up year over year. Check, good. That's a good thing. Inventory down 16% year over year, guys. That is also a good thing. But something you flagged, Julie, there were a lot of negatives in this quarter. First and foremost, and I have not seen this from Target for a long time, comparable sales of online, they were down 3.4% year over year. Last year, at the same time, they were up over 3%. Sales marginally grew year over year. And I was on a call with other reporters, and on that call was Target CEO Brian Cornell and CFO Michael Fidelki. And they did deliver a story of a more cautious consumer, that they're in there buying essential goods, food, cosmetics, you name it, but then they might be leaving the store entirely and leaving all those home goods and apparel goods on the shelf. So cautious consumer. I think that the consumer has started cautiously shopping at Target to kick off the second quarter. That is a tone we heard from Home Depot on its earnings call yesterday morning as well. So the overall mood, I think a cautious consumer to kick off the summer shopping season, which bigger picture, I think calls into question on how the key back-to-school shopping season will start for Target and many other retailers.
Yeah, and this was interesting too. The operating income margin rate, 5.2% in 2023 compared with the 5.3% that they saw in 2022. Reason I bring that up, I know that in the conversations that you've had with the executives and even what they've talked about in previous quarters, they're looking to get that figure back to 6%, and they weren't expecting that to really take place until later on in 2020, fiscal year 2024 at least. I mean, is there anything to kind of read into there to say that there is perhaps a light at the end of the tunnel in getting to some of those margin targets as well?
Well, that's, I think you're essentially trying to maybe call up, has the operating margin bottom for Target? And perhaps it has, in large part because they have gotten their inventory under control. Also, on that call, reporters Cornell and Fidelky talked about further cost savings initiatives as the year went along. Unclear what those initiatives are. It's unlikely Target is closing stores en masse to make an earnings number. But again, it sounded like a more efficient Target at a time where the consumer is under a lot of pressure. And then the second part of the story, of course, is I've never seen, I would say, a more cautious tone from Cornell on this issue of retail theft. He started his earnings call, or earnings statement, I should say, talking about a $500 million hit from retail theft this year. That is not something you normally see on a retail earnings release, and it's not something I'm used to hearing or just talking a lot to Target about it, but it looks to be an increasing problem, not just for Target, but a lot of other retailers.
Yeah, there's some big numbers attached to the overall retail industry about this. Did Cornell talk a lot about what to do about an issue like this? Because it's not just, we're not just talking about sort of shoplifting, right? It sounds like it is organized theft that is going on at the stores, right?
And I have more on this. There's a deeper dive story on the Yahoo Finance homepage discussing some of this, some great analysis, really a nice study from the National Retail Federation. I encourage everyone to check that out to really understand an issue, Julie, to your point. It is not someone going into a dressing room with 3 shirts, putting 2 of them on and walking out with 1 and then paying for that. That's not the issue. These are coordinated attacks on retail, while chief among them, smash and grabs. So large mobs go into retail stores, smash things that might be locked off, mouthwash, home goods, you name it. They go in there, take things in mass quantity and run out the store. And then also a lot of I think, theft happening on the docks as well, which is, I think, a story that has gone underreported as well. But it all takes money or takes a bite out of Target. And this year, it will be a $500 million profit hit. Over 2 years, Target is calling out a potential $1.2 billion hit to profits. That's last year and then this year from retail theft alone. That is huge. And I didn't get the sense from Cornell and Fidelky on this call, reporters, that they're able to address it. Are you going to just hire 75 more people in each store to try to, fend off a flash mob of people looking for 30 cases of mouthwash? Unclear. They have no issue. It's hard to figure out how they're going to do this.
One more thing on Target, as we sort of put a pin in the conversation for now. They didn't change their forecast for the full year. All of these headwinds aside, headwinds in this quarter, and I think that's why the stock is not performing worse, because even though the second quarter sounds like it's going to be rough, maybe things will improve to some extent in the remainder of the year, but we're going to talk to an analyst about this later. Corey Tarlow from Jefferies is going to be joining us to dig into these numbers a little bit more.
Real quickly, I asked Brian what would have to happen to the economy to hit that low end of the guidance. He didn't really say what those things would be to struck an upbeat tone, but I think this is Target reaffirming their guidance for 2 reasons. They're betting on a big back-to-school shopping season and an even bigger holiday season, which is a tall order given where the consumer is in this country.
Yeah. All right. Maintaining their full year guidance for right now, at least, based on some expected benefit from efficiency and cost saving efforts. As you mentioned, our own Brian Sozzi joining us to break down all things TGT. Well, time now as well for today's morning brief. We have been keeping close tabs on everything discretion, the mentions about the consumer and how the consumer is even changing some of their own spending. Take a listen to some of the executives and what they have had to say to us here on Yahoo Finance about the very term.
So far right now, the customer is really hanging in there, but we're obviously watching what everybody else is too.
We sold more large hamburgers than we have in the last 6+ years, at a time when we have a trade up from 4 for $4 into a $5 biggie bag into a $6 biggie bag. So we feel like we got a good menu construct to bring folks in for one more visit, drive one more dollar that works for the consumer.
We have pricing power, but we're really thoughtful about it. We want to always remain a sweet, indulgent treat that's affordable.
We haven't seen much pushback. In fact, our loyal customers at the top end of our traffic, they've stayed with us. Those numbers have really been pretty even across the board. If anything, we've seen some pullback in maybe some of the less frequent shopper as we've kind of evaluated what's happened so far in 23.
However, there now seems to be a change in the tide as 2 recent events point to consumers being more selective on spending. Home Depot's unusually grim outlook, in part due to softer demand that pushes forward the discretion narrative for consumers. Meanwhile, U.S. retail sales for the month of April, they came in lighter than estimates. As far as the better than expected rise in ex-autos and gas, EY Parthenon chief economist Greg Dacko told Yahoo Finance that the non-inflation adjusted number is a key distinction there. And with Target joining in on a downbeat outlook, investors will be keen on Walmart's results for more clues on the consumption of discretionary goods here. And so for much more on this conversation, let's bring in our guests here this morning. Julie, you wrote this morning brief as well. Wanted to give you a shout out there.
Thank you. And obviously Target also following in this narrative this morning. So let's bring in Chris Versace, Tematica Research Chief Investment Officer, and Mira Pandit, JP Morgan Asset Management Global Market Strategist. Thanks to you both for being here. Really appreciate it. It does seem like something has started to shift, right? And one of the other differences, I think, in some of these early retailers versus those companies that we just heard from is that their quarter ends at the end of April. So, Chris, how concerned should we be?
Well, if we always try to follow the data, right? And there's a lot of data to be had. There's the monthly retail sales reports that you guys just alluded to. There's spending pulse data from MasterCard. Visa has a similar index as well. And when you kind of trace it back, some of this isn't exactly fresh news. Okay, so we've been a little concerned about certain areas, clothing, for example, furnishings, electronics. And as we saw in the April retail sales report yesterday, those areas were not only down for the month of April, but they were down for the 3 months leading into companies that report that quarter. So when we size that up against what we saw, Home Depot, for example, but really today with Target, not necessarily a huge surprise. But at the same time, Target said something that was interesting, right? Which is that the frequency business is doing well. So if you think about what that is, they called out beauty, they called out grocery. All of a sudden, you start thinking about Walmart, largest grocer in the U.S., right? You start to think about Costco and what's done leading into fresh food. Those types of reports, those companies could perform perhaps a little better than expected, whereas others that are more clothing heavy, electronic heavy, Gap, for example, who reports next week, could be a little more ominous.
It makes sense.
Right, and we've talked about as well, Mira, the fact that there's been perhaps this replenishment rate, not just among end consumers, but also among some of the retailers who are now impacting the kind of broader base of companies that are manufacturing some of the more durable goods or even the discretionary goods in the form of electronics as well. How long can that cycle continue to have perhaps a broader economic impact as well here?
Well, what we saw was we had a lack of inventories in the heat of the pandemic. What we ended up seeing is that all of a sudden people overbuilt inventories. So then we had this cycle throughout the course of last year of excess inventories, things going on sale. People no longer want all the goods that they wanted during the pandemic. So we're seeing an evening out of that dynamic. I would still say that the consumer is shifting from goods to services, and we're seeing that in a broad array of data. So I think it's going to continue to play out a little bit more, but I think that the brunt of excess inventories is probably behind us. When we think about the broader shape of the consumer, we're seeing that excess savings continue to dwindle. We're seeing savings rates that are lower than pre-pandemic. We're seeing credit card spending that's higher than pre-pandemic. But what's important is this is a slowdown from the pandemic itself, and yet the consumer is not weak. It is softening, but it is not weak. And that is, I think, where we've kind of hit up against some intellectual challenges in terms of thinking about the comparison to the last 2 or 3 years versus really kind of getting back to that pre-pandemic trend of normal.
Well, and as I wrote about in the morning brief today, it's not that they're weak, they're choosier. They're using more discretion when they're making purchases, right? I do have to wonder when this is going to start to be felt in services, right? And this is something we mentioned. EY Parthenon economist Greg Dacko a moment ago. He brought up the idea, well, we really got to watch that summer travel season carefully because tickets are expensive. Are people going to start to get choosier there? What kind of signs are you looking for on the services side?
Continuing, as you say, to look at travel, to look at restaurants, not only the demand, but also even on the hiring side. Because if you start to see some of those job openings dry up and you start to see less hiring, less for hire signs, then what that means is that demand is coming down pretty organically as well. So we look at both the labor side of it, the demand side of it, again, a wide array of data on the consumer itself and consumer surveys, consumer sentiment to see how consumers are actually feeling about inflation and what they're willing to spend on going forward. But I do think, again, given the starting line over the last couple of years, it will be still a gradual weakening in the consumer and it will take some time. So when we think about broader economic growth, Where our pain point is perhaps not in the consumer, which is 70% of the economy, but more around businesses, business confidence, their access to loans and borrowing as we're seeing more credit tightening. So if we think about a slowdown in economic growth and a potential recession later in the year, what we're seeing potentially is that being driven more on the business side than the consumer side. And luckily, the business side is smaller relative to the consumer, which means we could potentially see a more mild downturn.
And so, Chris, with what you were mentioning earlier, the strength in frequency businesses offset by, of course, the softness in discretionary categories, which we've been talking about, who is best positioned right now to benefit from the frequency business that Target is calling out?
Sure. Well, I would say probably the two I already mentioned, right? One is going to be Walmart, because you're going to go back. You're looking to, just given the backdrop, right? Consumers are looking to stretch these disposable spending dollars. We know that consumer debt has been rising. We know borrowing costs are going to be higher. They have been able to manage these because of the wage gains that we've been getting, but they are starting to really stretch those dollars. So to me, the two companies that really stand out, first will be Costco, very differentiated business model, that membership stream, simply wonderful in my opinion. And then the other is, of course, is going to be Walmart.
Yeah, I mean, that makes sense when we're talking about staples. We also heard from many of those Staples CEOs that are continuing to do well here. We're going to ask you guys to stick around because we have a lot more to talk about with you. But got to tell you what is latest with Elon Musk and with Tesla and Twitter and all things Musk, basically. Tesla shares are higher in early trade. We've now got about 15 minutes to go until the opening bell. And we've got really three takeaways from the EV makers' annual shareholder meeting in Austin, Texas, and also, of course, Musk speaking to CNBC. One, Elon Musk is renewing his vows to Tesla, dispelling rumors that he's going to leave the company, saying he is indeed staying on as CEO. And this comes, remember, after Musk welcomed a new Twitter CEO, NBCU's former advertising chief, Linda Yaccarino. He talked again about her strengths in the Twitter role as well. At the meeting, Musk referred to Twitter as a short-term distraction and says the platform is now, quote, stable. But he also said he's still going to keep on tweeting a lot, it sounds like. Next up, Musk says Tesla will try a little advertising. That is a big departure for a company that has normally bucked traditional advertising and really relied on word of mouth in order to sell product. And finally, the news that many investors are waiting for. Musk says that Tesla's going to deliver its first Cybertrucks this year. We're going to have to debate all things Cybertrucks, I guess. We're going to talk to Tasha Keeney a little bit later on ARK Invest. She looks after the Tesla position there and does research for the firm. That conversation coming up at 10:15 a.m. Eastern.
Well, lawmakers edged closer to a deal on the debt ceiling as well on Tuesday. It's the default X date that looms ever closer here. And as we're continuing to track this after yesterday's meeting, President Biden's representatives will negotiate directly with Speaker McCarthy's team. This is a sign of progress as talks continue, although the two sides remain far apart on an agreement. House Speaker McCarthy told reporters it's possible to get a deal by the week's end here. So what does this all mean for the markets? We've continued to monitor this at length, and with us again to discuss, we've got Mira Pandit, JP Morgan Asset Management Global Market Strategist, alongside Chris Versace as well here, Tematica Research Investment Chief Investment Officer. So first and foremost, I mean, if we're thinking about the broader implications that this has or has shown up in the markets as a result of the debt ceiling, serious issue, material movements that we've seen in the market that correlate to this, or is the market just saying, yeah, you know what, this will get done at some point?
So far, the market doesn't seem to be reacting. In very short-term paper and very short-term T-bills, you see a little bit more of that. But for the most part, when we look at 2-year yields, 10-year yields, a lot of stability we've seen over the last couple of weeks. And same with the equity markets, don't seem to be pricing in an issue with the debt ceiling. So I'd say we're not seeing a lot of market volatility yet. And I think that is because investors understand that the debt ceiling has been raised or suspended over 100 times since World War II. Regardless of the political party, every single president back since 1959. So I think that investors are confident that a deal will get done. As we get closer and closer to that potential X date, as we get potentially, closer and closer to early June, I think you could see a bit more jitters within the markets. So something to be mindful of, but investors can still position around this. We can still apply risk management to this potential threat. I'd say if we look at 2011 as a comparative point in terms of when we almost breached the debt ceiling and did see a credit downgrade, you saw the traditional safe havens do well. The dollar, gold, treasuries. I'd say with the dollar and gold, what's different this time around is last time we were also amidst a European sovereign debt crisis. Right now, Europe is actually looking better from a growth standpoint, so perhaps less pressure into the US. And from a gold standpoint, now we have yield, so the opportunity cost of holding something like gold is higher. Instead, we'd play this through the Treasury market, because if there were to be a default, you'd see that in paper that matures around the X date. You wouldn't see that in the broader Treasury market. So actually what we saw last time around, yields fell, bonds protected. If we have no volatility related to this, we're still anticipating that yields are going to come down as growth and inflation soften. So ultimately, you can see some benefits either way in the bond market.
What do you think, Chris? How's this going to play out?
Well, I think she's right. I think we've been conditioned to just expect an 11th hour deal, but as always with any deal, the details are really going to matter. And I think that's why when you see certain sectors have traded off, like defense, right? Questions, will defense spending be cut, right? We take a look at some of the healthcare sectors as well. You know, what is going to happen, not necessarily in the coming 12 months, but down the road for Medicare, for example. And I think some of these areas will probably hold up better than expected. You know, so we've been actually recommending folks for shares of like Lockheed Martin, Elevance Health, that these pullbacks have actually made for nice entry points. So you really need to understand the moving pieces, but make no mistake, you know, until we know what the deal is, there's going to be some uncertainty.
Yeah, definitely. What's more important right now, the debt ceiling or the Fed?
Sorry to laugh. You know, we were chatting before we came on, and we said, really, if you look over the last year, it's been nonstop. There's been one thing after the other, and you know, I think the concern is, even though you know the next couple days, right, it's likely to be the debt ceiling, then we're going to revert back to the Fed and whether or not we're going to get rate cuts or not. But complicating all of it is we have a gaggle of Fed heads speaking this week with Powell on Friday.
We've already had a lot of them,
yes,
right?
Yeah. And the message has increasingly been, inflation is persistent. We do not see rate cuts. You know, it would not be prudent to think about rate cuts. And yet the CME Fed Watch tool still shows a couple rate cuts. So at some point, the market has to wrap its head around this and focus on what's likely to happen, not what it wants to happen.
Yeah, that is a very good point. All right, we're going to get you guys to stick around and continue this conversation in just a bit. Chris Versace and Mira Pandit, don't go anywhere. Coming up, should we call this the AI rally in the markets? Mentions of artificial intelligence have been off the charts this results season, but is the fervor overdone? We'll get into the conversation shortly. get to some movers now. We've got a mixed picture for TJX, the parent company of Marshalls, TJ Maxx, and Home Goods. Reported a revenue miss in the latest quarter, but full-year guidance also fell short of estimates despite an earnings per share beat. The company adding to the shrinking inventory narrative, seeing inventory drop 5% from last quarter, although that's not necessarily the same kind of shrink when retailers talk about theft. That's usually what they mean when they talk about shrink in those terms. In any case, you see there what the numbers look like for the quarter here. But I think it's interesting that here, unlike a Target, the company is coming out with an increased forecast for the full year.
Yeah, a lot harder to five-finger discount a sofa out of Home Goods than it is toothpaste out of TJ Maxx or Target for that matter. But at the end of the day, I mean, Home Goods, since I mentioned that off the top here, first quarter, those comp store sales were actually down by about 7% here. And you think about some of the categories that have continued to face headwinds. It is the home category combined with some of the apparel and electronics. But for a company that dabbles in at least two of those three elements in a more outsized way, TJ Maxx certainly one of them here. Overall comp store sales, though, they did increase by about 3%. That is at the higher end of the company's plan and driven by an increase in customer traffic, they're noting here. So as consumers are changing how they comparison shop, we've seen that show up in how they shop based on the retail sales data that came out earlier this week, even if digital sales were looking stronger in that report versus what we had seen in Target's specific numbers. It's a broader question of where for the in-store capacity they might be doing some comparison shopping as well. And typically TJ Maxx and some of the companies that are underneath of that umbrella give them that opportunity to, at least on price, comparison shop.
Right, and TJX had also been the beneficiary of some of the inventory overruns at other companies, right? It takes that inventory off their hands and sells it. So it'll be interesting to see now that you have a little bit of an inventory normalization in the channel if there is less product that is coming TJX's way. One more note, and I'm going to have to listen to the earnings call, which I think is ongoing for the company. There was some question over whether it might benefit from the bankruptcy of Bed Bath & Beyond. So, are they able to take share in that environment? So we'll have to check that out and see if that's what's going to happen.
I'm on the lookout for some Gucci flip-flops over at TJ Maxx. So if you see any, just flag them to me, folks.
Yeah. Good plan. I'll take a look at that for you guys. We've got the opening bell on Wall Street coming up in just a bit. Let's bring back in our folks here to discuss what the kind of setup is here this morning. We've got Chris Versace of Chematica. We've got Mira Pandit of JP Morgan Asset Management. And Mira, it does feel like, Chris was earlier talking about all of the push and pull, and it's like one thing after the other that has been happening recently in the markets. But it also feels curiously sideways at the same time. Given that we are sort of in this event overload, if you will, what's going to be the thing that will be a catalyst to the up or downside in a more decisive fashion?
Well, let's consider what we think is priced in and what we don't think is priced in. So in terms of things that are priced in, it looks like based on both yields and the equity market, a Fed pause is priced in at this point. And what we saw last year was as expectations for the federal funds rate continued to rise, the stock market continued to fall, and of course, yields continued to rise. So now that we've seen a little bit more stability, it seems like that's reflected. But I think the reason we haven't seen a more pronounced leg down is the fact that it's hard to deny that economic data has still been pretty solid, mixed at worst. But for the most part, it's been fairly solid, and it's really hard to see earnings fall in the immediate term that much further when economic data is still strong, when the consumer is still strong. So while I think that weakening could come in due course, it hasn't happened yet. Therefore, stocks don't really have that downward catalyst to react to yet. But I don't think we're pricing in all of the different situations that might arise when we do potentially have a recession. So perhaps that is the next shoe to drop. But even if we look under the surface of the market, a lot is being driven by a couple of tech stocks. The rest of the market actually has been reasonably weak and hasn't really gained that much on the year. So a little bit in wait and see mode.
What does it say that the move, at least in the S&P 500 that we've seen to the upside, where we've still been basically going sideways to this point, and we've got just seconds to the bell, so maybe I'll save this question for the other side of the open, but just putting it on the table, we've been sideways, and throughout earnings season, we've stayed that way. We haven't seen an outsized move to the upside yet.
3,800 to 4,200, back and forth.
Yeah, definitely a little like ping pong ball back and forth between those. There's the opening bell on Wall Street. Let's do a quick check of the markets as we get underway this morning, sponsored by Flex Shares. And we do have a little bit of upward movement here in the major averages, still waiting for the Nasdaq to open up since it's a bigger index than the others. It usually takes a little more time. But we are seeing a little bit of upward movement here, which is interesting given the trepidation that we saw reflected yesterday after Home Depot, and now coming with Target, but maybe Target's news sort of mitigated by, again, not changing that full year forecast. So all three major averages in the green, up about 0.4%. And we'll continue to watch the retailers very closely, not just Target today, but of course Walmart going to be coming out. It looks like Target is down a little bit here at the open. Has been sort of bouncing back and forth between gains and losses ever since those numbers came out.
Absolutely. We're also watching shares of Western Alliance this morning. They are rising after the bank said its deposits grew by $2 billion in the second quarter. Deposit levels at the regional banks have been under scrutiny after the collapse of several regional banks. Let's bring in Chris Versace and Mira Pandit back into the conversation here just to give a little bit more of the details on the deposits. They've said that deposits have stabilized. We're approximately $49.4 billion as of Tuesday, May 9th here. Quarter-to-date deposit growth of about $1.8 billion from $47.6 billion as of March 31st here. And so, all of that considered, we're really just looking for the deposit stabilization to perhaps signal the end of a flight of deposits, or a flight of withdrawals, rather, from some of the regional banks here. We've continued to put the question out there, even to some of the senators, is the crisis over? And are the deposit and the withdrawal concerns done as well?
It's not over till it's over, Brad, right? I mean, I hate to say that, but that's the truth, right? So, there's always going to be a lot of ripple effects, and it's going to take time, right, to vet all of this out. But the more distance that we put, right, between Silicon Valley Bank, Signature Bank, and where we are, I think people can get a little more comfortable with it. Having said that, we've not even looked at any of the regional banks. We've actually preferred to play that flight to quality with larger banks, particularly Bank of America, because of the business mix that we like. Relative to that, and the shares have come down quite a bit, 37 to 27, 28, depending on where it is on the day. So, the bulge bracket banks will be capturing some of that outflow. They already have, and to the extent there is any incremental, they probably will.
So sort of leaving aside the systemic and macro question for a moment, you're addressing whether you want to buy the banks right now. How are you guys thinking about financials?
We're thinking that, look, in a cyclical perspective, this is not the best time for financials in general, outside of some of the banking considerations. Yields are not necessarily going to move in banks' favor over time. So we want to be considerate of the fact that if we're thinking about recession oncoming, that we also have to think about some weaker profitability pictures for some of those financials. So we're a little bit more cautious there in the meantime until we start to see more of a turnaround there and some of this economic growth picture play out.
Well, the biggest trend on Wall Street as well that we're tracking here right now could be the reason behind the latest stock market rally. Of course, we're talking about AI. Just this morning, Alphabet hit $1.5 trillion in market cap for the first time in over a year. The tech giant getting a boost from the AI hype. And shares of Alphabet are up 35% this year after a dismal 2022, right alongside Microsoft, Meta, and Amazon, which are all enjoying double-digit gains for the year. So is this rally all AI hype here? I mean, have we seen so many companies just mention AI and the market say, all right, yeah, automatically there's a multiplier effect that you have to benefit from?
So I'm going to use one of my favorite words called hopium. There is, I think, a lot of that in there, because when you look at the end markets, like for Microsoft, data center, okay, moving along, not necessarily shooting the lights out. PCs continue to be weak. And you look at some of the other end markets, also for NVIDIA, for example. What has been the common thread here? It's all been what you just said, the mention of AI. And what bothers me a little bit about it is how companies like PepsiCo, Wendy's, and others are starting to talk about how they will be using AI and how that's going to really change their business. And then all of a sudden, I flash back to 1999, 2000, and the dot-com era, when all sorts of companies were like, well, we're no longer X company, we're X.com company. And it's almost like, I got to be in the game, I got to say something.
Which was actually different for Apple, because they didn't bring it up voluntarily. It got brought up in a question for them.
Yes, that's 100% correct.
Although for Apple, it makes more sense than...
It does. It makes way more sense than
Coke or
Wendy's.
Pepsi, for example, where it's like a random bolt-on.
Yeah.
Well, but I mean, if you think about your iPhone, you are already carrying AI around with you day in, day out. So I am I concerned a little bit that this is overdone, right? Typically when we have some new thing on the technology front, expectations do get, big, and companies' shares can get out over their skis. So the question to me is, what's the pop in that potential bubble? That's what I'm watching for.
I want to ask you about a specific one of those names that you mentioned, because I know, Mira, you talk sort of more broadly, but I want to ask about NVIDIA, because this is stock that has doubled this year. It hasn't even reported its earnings yet. That's set for, a week from today.
Next week.
So is this AI is sort of really knit into the fabric of what NVIDIA chips do and what they want them to do. Does it make more sense for a company like this to be up that much? Or is it also too much?
I would say that it's going into their earnings, it's probably priced to perfection, which means that they need not only to deliver, they need to beat and raise in order for the stock to move further higher.
AI as a theme, if investors were to even try and position their portfolio or have some type of exposure to AI right now, from what we've heard even in the mentions over the earnings season, I think Mark Zuckerberg actually did the best of laying this out, that it's applications that live on top of the language models that live on top of chips. Is there a strong thematic play that's emerging right now as a subset of AI, perhaps?
I think we need to not put the cart before the horse here, because I see a couple of different headwinds from an AI perspective if we bring in the macro story. Because one, if we think about what AI is going to require, it's going to require businesses to spend more, precisely at a time where profits are weakening, companies are trying to batten down the hatches a bit and preserve the profitability. So that's a little bit of a headwind there in terms of how much additional spend can go towards this in the near term. The other thing I'd say is, I think with a lot of these technologies, they actually require more workers up front, even if eventually they will save on the labor force. So if we think about the workers' position, the shortage of workers we have, the very specific training that might be required, I think there are some headwinds when we think about the supply of workers and companies' ability to put capital in the near term.
And sorry to interrupt, Mira, but as you're talking, it occurs to me, do companies also risk putting over-resourcing AI at the expense, because of the hype, because of the push by investors, at the expense of core businesses?
That's the risk. Yeah. You don't want businesses to be playing in too many sandboxes at the same time. So I do think that this is the time where businesses need to really focus, and businesses have been good about focusing on wage pressures, cost pressures, higher dollar over the last year or so, and making some tough decisions. I don't think company managers should lose that discipline in the face of the newest shiny object. Now, I think long-term, to your point, this is a huge theme that will play out over many years, but we might need to be a little bit patient. Think about, again, some of the ancillary technology required, the inputs required over a longer period of time that can fuel this theme. But I think that the huge run-up in markets solely around AI enthusiasm might be a little bit beyond its skis.
Chris, I saw you leaning in about to jump on the table.
I was just going to say that, we have to kind of differentiate between actual spending and investment on this compared to companies talking about it. Because in this environment, if you trace it back over the last several weeks, Microsoft shares took off, right? And Google shares lagged behind really until very recently, especially come out of their I/O event, where they really talked about how they're incorporating AI not only into Bard but in other areas, saying that, hey, we are in this game. And again, if you look at that as the model, companies that don't really talk about it, there's going to be this perception that, oh, maybe they're falling behind, and they won't want that.
Are we underestimating what the regulatory framework for AI may look like at this point?
My suspicion is yes.
Yeah.
Yeah, I mean, at the same time, as if we have companies that risk not talking about it, is that and falling behind, is that an opportunity for investors? In other words, just because a company isn't talking about it doesn't mean it's not doing it. It doesn't mean it. Do you know what I mean?
Yeah. Well, take your point on Apple, or Brad's point on Apple, right? They are doing it. They are investing in it, but they're not necessarily talking it up. I think the one thing I will say is not for investors, I think for traders.
Gotcha. Okay. Important distinction always to make.
Great to have you both here with us today. We've got Chris Versace, Tematica Research Chief Investment Officer. Chris, great to see you as always, as well as Mira Pandit, who is the JP Morgan Asset Management Global Market Strategist. We appreciate the time this morning.
Thank you.
Absolutely. And coming up on the other side of this short break, we go back to the bullseye. Target beats the street, but that's not the story here. The outlook, yeah, it's grim. Same-store sales basically flatline. Consumer becoming much more selective. We've got more on all of this next. Let's head on over to the New York Stock Exchange with Yahoo Finance contributor Remy Blair with the latest market action here early in today's trade. Remy.
Well, U.S. markets have opened higher with the major equity indexes all in positive territory. The Dow Industrials, Nasdaq, and the S&P 500 are all higher on this Wednesday morning. And believe it or not, in terms of the Nasdaq 100 index, it is up by a whopping 20% year to date. And that is a stark contrast to the Dow Industrial Average. Now, what's behind this outperformance for the Nasdaq 100? Well, better than expected earnings from top tech names, including Alphabet, as well as Apple and Microsoft, have contributed to these gains. And today, all eyes do remain on retail earnings. We got results out from TJ Maxx as well as TJX, which is the parent company for TJ Maxx, as well as Home Goods, as well as Target. And as mentioned earlier, Target's results did beat expectations, but it was not quite a bullseye. For the retailer, it did report an earnings beat, but shoppers do remain cautious. And this is a trend we've been seeing with Home Depot earnings as well, and we will be getting more retail earnings out this week. So consumers are being very cautious in terms of discretionary spending, and both profits as well as sales growth for Target were down in the recent quarter. We're seeing consumers spend less on discretionary items and spending more on food as well as household goods. And we are seeing TJX company shares higher in tandem with Target shares this morning. The company reported its annual profit forecast, and that parent company of TJ Maxx, as well as Home Goods, is betting on lower costs as well as demand from price-conscious consumers. Now, TJX is seeing expenses come down after higher freight as well as labor costs ease in the latest quarter, which means a boost to margins. The company is also expecting 2024 adjusted profit to come in above its previous range, and it also maintained its full-year forecast.
Thanks, Remy. Appreciate it. Well, she just talked about Target and what we're seeing there. The company's underwhelming guidance for the second quarter coming as consumers are faced with economic challenges, including, of course, elevated inflation. A somber tone compared to what was a better than expected first quarter for the retail giant. Joining us now with a deeper insight on the road ahead for retail, we've got Jefferies equity research analyst Corey Tarlow. Corey, thank you so much for being here. It's good to see you. So interesting here that we now have Home Depot and Target making this kind of commentary. It's in pretty sharp contrast to a lot of the sort of consumer packaged goods companies, food companies that we heard from earlier in the quarter. Of course, the retailer's quarter is a little bit longer, or a little bit timing goes into April. Does that mean it was April in particular that really started to deteriorate here? What do you think?
Thanks for having me, and good morning. So what I would say is that the consumer throughout the last 3 months has softened materially. And we see this in the data that Target disclosed today. So when they talk about February and March and April and even in May to date comps, February started off strong, but March decelerated a little bit, and then April actually decelerated further. So that ended up driving about a flat comp for the overall quarter. I think that what's important here is, as we dissect the sort of 3 major categories that I think I want to touch on here today, it's the customer trends, it's category dynamics, and the outlook. So on customer trends, traffic was up, which is a good thing. It's been up for 3 years straight for Target, actually. But ticket or basket was down slightly. So what we're seeing is people are going to stores more often, but maybe their baskets are not as big as they once were. Second on category, so food and beverages were up. They've been up, I think, 61% since 2019 and gaining share materially in that category. That's great. However, the discretionary category continues to be pressured, and that softness has actually continued into the second quarter. And then thirdly, just on the outlook, they reiterated the full year outlook, but what's interesting here is that the second quarter outlook was actually below expectations. And so that just makes the full year a little bit more back half weighted, and therefore adding a little bit more risk to the third and fourth quarters ahead.
And also perhaps, Corey, the risk to Target's goal of reattaining that 6% operating margin, right? Because correct me if I'm wrong, but isn't the discretionary stuff versus groceries, isn't that the higher margin stuff? So if people are not buying as much of it, is Target going to have a hard time reattaining that 6% operating margin?
So over the last 10 years, interestingly enough, Target's actually averaged an operating margin of 7%, but the target for next year is expected to be around 6%. This last quarter, they generated an operating margin of 5.2%. For the second quarter, they're expecting the operating margin to be slightly below that. Near term, there are a lot of dynamics at play that might help to support driving better margins, like, for example, lapping all the inventory and markdown issues that they had last year. But there's also some headwinds, like shrink. That continues to be a problem. They dimensionalized that issue to be about $500 million this year, or $500 million, versus I think it was $400 million through the first 3 quarters of last year. So shrink continues to be a problem. It continues to worsen, and it does impact the near-term profitability trajectory. But ultimately, I do see a path to returning to that 6% or maybe even 7% over time.
I mean, why does there seem to be an outsized hit on Target? I mean, are they just bear with me on the pun, are they just an easier target at the end of the day for theft?
I think that it's impacting a lot of retailers at present. Target does have mitigation efforts in place. They're working with local law enforcement. They're working with the NRF and RELA, so national retail organizations, and with other retailers as well to help to mitigate the effect. They're also adding in more shelf security in stores to help impact the overall shrink issue. Is it going to disappear tomorrow? No, but it's an issue that over time should lessen as these initiatives hopefully tend to bear fruit and mitigate the overall issue that Target's facing from a shrink standpoint.
Yeah, and Corey, let's extrapolate to the other retailers, right? We're going to hear from Walmart. We were just talking with a guest earlier who said, you know, if people are leaning into groceries, that could be something that would benefit Walmart. But do you think we're going to get sort of a similarly cautious tone there?
I think you'll get a cautious tone, but you're likely to see much stronger results. And it's just because Walmart is gaining very significant share from many other retailers and across the consumer income spectrum. It's gaining share from among lower income consumers, middle income consumers, and even some higher income consumers too. And so that's really going to drive outsized traffic growth as well as pricing potential, because Walmart has all the footsteps to be able to command some pricing power now. And especially as supply chains have normalized, it also unlocks the ability for Walmart to pivot into private label. So they can now emphasize their great value brands that they offer, and at the same time, not only drive sales, but also better margins too, coming off a year which was arguably a very difficult one with all the inventory and supply chain issues that they faced that hindered margins in the prior year.
You know, we often talk about in the banking sector how some large banks are just too big to fail for many mechanisms or another. Is Walmart too big to fail as a retailer?
I think that there are certainly aspects that Walmart can improve upon, but I think that if you look back over the last 10 years, it's been quite a journey for the company, and they've really done an exceptional job controlling what they can control. And this year, they probably arguably have the most within their control that they've had since the onset of the pandemic. And what that's unlocked is better visibility into inventory, into supply chain, and unlock the ability to also drive better sales and margins. So if we think about the automation that Walmart is adding into its distribution centers, the data that it now has available at its disposal from a digital and omni-channel standpoint to help to understand its customer better and predict where and what its customer needs and where and how the customer is going to shop, really should all unlock much more greater profitability and visibility into the financials as we look ahead. So I don't really foresee any too significant issues for Walmart ahead, because they've really de-risked, I think, the story to a substantial degree thus far this year. And I really do think that it's one of our top picks in our coverage, and it's certainly a stock where we see substantial upside.
And finally, Corey, just to zoom out once again and take a look at the consumer, I know this current period, it's a little bit tough to find analogs in other periods of time. Obviously, the pandemic was a big idiosyncratic event. We have still inflation that, while it's moderating, is still rising. We have concerns about the economy. But in as much as we can predict, what tends to happen with consumer spending patterns in this type of environment, and how are you sort of gaming out the rest of the year and even going into next year?
Sure. So one thing that we actually pay pretty close attention to is the Senior Loan Officer Survey. And what we've noticed is that when credit tightening occurs, retail spending also tends to lag on about a 9-month basis. And what we're starting to see is loan standards are tightening significantly. So in a very short period of time, I would expect that retail sales will follow suit. And at least internally, our economist is predicting a recession in the third quarter. But if we think about how some of these retailers, like Walmart, for example, perform during recessions, they're actually fairly relatively resilient. For example, in 08-09, Walmart comped up on a 2-year stack basis up 4%. It wasn't as strong as Dollar General, which was up 20%, but it was much better than the retail average of down mid-single digits. So it's clearly one that we expect that is, despite what economic uncertainty may come, is very well positioned to outperform.
Corey Tarlow, Jefferies analyst, joining us here to talk all things retail, but specifically Walmart and Target for much of the conversation here. Corey, we appreciate it as always.
Thank you very much.
You got it. Coming up, the Fed's big debate continues. Why our next guest says decisively communicating is a key challenge. We'll discuss next.
Welcome back to Yahoo Finance Live. I'm Julie Hyman with Brad Smith, and taking a look at some of the sector action here today. We've got consumer discretionary that is helping lead the pack here. We did, of course, get some retail earnings, which we'll look at in a second. Financials also doing well in today's session. So kind of cyclicals leading the pack here. On the downside, we've got traditional defensive groups that are lagging: healthcare, utilities, and just consumer discretionary. So speaking of the retailers here, let's call them up and see how they are doing. Indeed, we have got Home Depot bouncing back from yesterday, which is quite interesting here. Target, which, as we said, has been bouncing between gains and losses ever since its numbers came out. Now it's at the highs. It's up about 1.5% right here. So that's quite interesting. TJX, which, as we said, also reported, those shares are up 3.3%. So this is definitely contributing to those gains in consumer discretionary that we have been watching. But also want to get back to the Nasdaq 100 and take a look at some of the movers there, since, as we've talked about, there's really been a domination of large cap tech thus far this year. That's happening again today. Amazon, also obviously retail, up about 1.6%. And Nvidia, I want to call it out again because the performance here has just been incredible. We talked about it a little bit with Chris Versace earlier of Tematica Research. Look at that. It has doubled year to date, in part because of all of these hopes around artificial intelligence. And the company reports 1 week from today. As Chris said, it is priced for perfection, meaning it not only has to come out and beat estimates, it has to blow them away in order to see potentially further upside from these levels. We're going to be watching that quite closely. In the meantime, we're also talking about banks again today. Another day, another testimony on Capitol Hill. Today, it's the turn of former First Republic CEO Michael Roffler. He addresses members of the House Financial Services Committee, and we know from prepared testimony he'll tell lawmakers everything changed overnight and that the bank was contaminated by panic in the aftermath of SVB's failure on March 10th.
And sticking with banks, our very own Jennifer Schonberger spoke with Senator Elizabeth Warren about her key takeaways from the banking hearing yesterday. Jennifer, we got to know, what did she have to say?
Good morning, Brad. In the wake of JP Morgan taking over First Republic and Treasury Secretary Yellen saying regulators would be open to more bank mergers, Senator Elizabeth Warren told me in an interview Tuesday she doesn't think mergers are the solution to stemming bank failures.
Not need to see making too big to fail banks even bigger as the solution. It's not. We now have to understand that weak regulation has left a lot of these multi-billion-dollar banks on shaky grounds. In order to put them together and create more concentration in the banking industry, that is not a happy solution. That is a bad problem made worse.
Instead, Warren wants to stop bank failures by occurring in part by giving regulators more authority to claw back executive compensation. Warren, along with 3 bipartisan senators, has introduced a bill that would require federal regulators to claw back all or part of compensation received by bank executives if a bank failed in the 5-year period preceding that failure. Warren already has bipartisan support for her bill, and she told me she thinks her bill will get further support to pass. Meanwhile, the senator is calling for an investigation into the former CEO of Silicon Valley Bank, Greg Becker, and whether he engaged in insider trading.
There is enough that was said in this hearing today that there needs to be a full investigation of insider trading for Mr. Becker.
During a Senate Banking Committee hearing Tuesday, Becker said he knew about the roughly 30 outstanding supervisory matters that were not disclosed to the public when he sold his stock options 11 days before SVB collapsed, but said he didn't believe he was in possession of material non-public information. Bottom line here, Warren says this is about realigning incentives for bank executives to ensure that they're not chasing short-term profits to boost their own compensation and then keeping those profits and compensation when a bank fails. Guys?
Jennifer Schonberger, thank you so much. Great interview. Appreciate it.
Thank you.
Meantime, more Fed speak, less clarity. The debate over June's meeting continues as Cleveland's Loretta Mester signaled that concerns Fed policy is not yet tight enough, but for others, voiced opposing views. Our next guest says the Fed's struggle to decisively communicate remains a key challenge. Eric Terray is Manulife Investment Management Global Macro Strategist, and he's here with us in studio today. Eric, welcome. Thanks for being here.
Thank you.
So, the Fed always gets criticized, right? For what are they going to do? Are they communicating well enough? But now is an interesting time in particular because you do get sort of conflicting or at least diverging to some degree views. How much of a problem is that?
Well, I think it's a problem in as much as, the Fed has a dual mandate. Inflation has a goal of 2% and full employment. And the Fed is still far away from its inflation or price stability mandate. So I think coming into the last meeting, there was this expectation that the Fed was kind of delivering an implied pause, and then the next piece of the puzzle was to really manage the forward guidance and the outlook. Markets have gotten a bit ahead of the Fed in terms of pricing in easing as a result of the data that we've seen. But the Fed, it seems to be now, and obviously what we're discussing at this point, is that there's still a bit of dissenting views around whether we've actually reached that terminal rate. And so I think that's the big debate right now is, does the Fed maintain the current level and then keep it for a while longer, or does it continue to push higher? But that just means, I think, a bit more tightening in terms of the economy, headwinds to growth, and then probably a bit more of a deceleration on the backside of that.
I know this 2% target has been out there since the Fed has been communicating it. Perhaps it's time to bump it back to the top of the inbox, though. Why is 2% the right target for the Fed here?
Well, I think, if this is something that was arrived at decades ago by policymakers around the world and, debated academically, there's a debate about 0%. 2%. Some emerging markets even have, 3 to 4. So it really is a policy preference depending on the country. But across developed economies, it's generally 2, and it's seen as, I think, a level that's acceptable.
A level that's acceptable, if not attainable, perhaps right now, right? So when we keep talking about how the markets are still pricing in a cut by year's end, despite the fact that the Fed really seems to be signaling that's not the case. What is the risk in that gap in what they're saying and what the markets are predicting?
Right. So I think, when we look at the inflation story right now, it's vastly different than what we've experienced in decades past, right? And so the historical analogs that we've had to assess the Fed's policy response or the policy reaction function is a bit different this time, in the sense that inflation is still well above target. And so the Fed just doesn't have the ability or the cover to actually deliver the easing that the market wants to basically price in. So until we get inflation really under control, we're a long way off from the Fed being able to deliver on the cuts that the market's pricing.
Does the Fed tip us into a shallow, mild, more severe recession even than is anticipated right now?
Well, I think that's the challenge, right? It's the whole debate about the soft landing. Are we going to be able to achieve it? So far, so good. Actually, so far, the data have been even more resilient, which is why we're having the debate about notching up that terminal rate. So I think overall what we have is an economy that's operating above demand, inflation that's still very hot. These are good things from a perspective of economic activity, but it's just delivering inflation that's well above kind of our comfort levels. And so that's the challenge for the Fed right now, is do they tighten even further, give us greater headwinds to growth, and then really start to decelerate the economy in a way that would achieve more of a hard landing than a soft landing in order to get back to 2%.
I want to ask about the debt ceiling as well, because that's the other sort of overhang for markets here. What we had in 2011 was that we got a downgrade of U.S. debt even after they came to an agreement on the debt ceiling. What's going to happen this time?
Well, I think
tell me right now, exactly what's going to happen this time?
Well, I think at the moment, looking across markets, it's a very calm sentiment picture, right? So volatility is low, the S&P's been stuck in a range, just limited movement across asset classes. I think the challenge is these are risk events that are typically very short-lived. They're typically classic risk-off episodes. You'll see, strength in havens like the Japanese yen, the Swiss franc, even gold, and then weakness in the U.S. dollar against some of the other G10 and emerging market currencies and risk assets more broadly. I think the challenge again this time is that emerging markets are in a much better place. Their interest rates are much higher, and I think for the U.S. it's a very different geopolitical situation where I think there have been kind of questions around the U.S. dollar's role in the global economy and the global financial system, and it's just not probably the best time to be maybe calling that into question, especially if you're doing it yourself. And so I think that's the big challenge, is obviously there are repercussions to what's happening right now. Obviously markets are calm, but if we look at the 2011 episode, it does have the potential to be a negative risk event for sentiment.
And so what is the correct portfolio pivot then if you are concerned about that?
Well, I guess there's two ways to play it. You can position for the kind of risk-off episode that may happen, or be ready to kind of buy when that risk-off episode does happen. Because again, as we saw in 2011, that risk-off episode was very short-lived, and so anyone who was kind of ready and willing to pounce would have done quite well.
Is there also an argument to be made to look outside of the United States right now, or will there be pretty dramatic spillover effects if there is a worst case scenario here in the U.S.?
Well, again, I think it depends on what asset classes you're speaking about. So if you're looking at equities, we've obviously seen continued weakness in emerging markets. And so although I just mentioned emerging market currencies, I think in terms of equities, those are still looking quite weak. For Europe and the rest of the developed economies, those are actually doing quite well versus the U.S. And so I think if you want to play a U.S., non-U.S. piece, you'd want to play non-U.S. developed.
Eric, thanks for coming in. Good to see you in person. Eric Terrouet is Manulife Investment Management Global Macro Strategist. Thank you. Well, let's take a look at a trending ticker that we're watching today. Shares of Wix are moving lower after the website builder raised its full-year outlook, down 2.75%. Talked about economic uncertainty, though. The company did post a net profit in the first quarter, led by cost-cutting measures, but we'll dig into and figure out why the stock turned down. It was up earlier. Coming up, Elon Musk making headlines with everything from Tesla's Cybertruck to ads, even his tweeting prowess. That's one word for it yesterday. But what are the key takeaways for investors? We'll discuss next. Let's do a quick check of the market, sponsored by Flex Shares. We've got markets coming off a little bit. When we opened up this morning, we were up about 0.4%. Now cutting that down to about 0.3, a third of 1%, or even a fifth of 1%, or even a tenth of 1% if you're looking at the Nasdaq here. But still, for now, all three major averages in the green. Elon Musk is preparing to drive his very own Cybertruck this year. The Tesla CEO delivering an address at the EV maker's annual shareholder meeting in Austin, Texas on Tuesday, and he provided an update on the heavily anticipated Cybertruck.
We're finally going to start delivering production Cybertrucks later this year, and I think the product, if anything, is better than expectations. Cybertruck is the car I will be driving on a day-to-day basis.
Musk touching on a number of subjects in his speech, from batteries, factories, to new products, to his time at Twitter. Tesla shares have been pushing higher this morning. For more, let's get to Tasha Keeney, ARK Invest Director of Investment Analysis, Institutional Strategies. Tasha, thanks for being here. So I want to start on the
Thanks for having me.
Almost throwaway comment on advertising that Musk made. That seems to be one of the things that the market is seizing on, that he said, oh yeah, maybe we'll look at doing a little advertising. Is that really going to provide that much upside for Tesla? It seems to have done okay with the core sort of word of mouth strategy.
Yes, I agree that that's what people seem to be seizing on. And, as we saw, it was a relatively off the cuff answer. He said, I want to listen to shareholders, so we're going to give it a try. I do think there's something to this strategy where, the research that we've done at ARK Invest suggests that thanks to Wright's law, battery costs have declined at such a rate that already, the total cost of ownership of an electric vehicle is cheaper than its gas-powered equivalent. Now sticker prices are also becoming cheaper. Tesla is actually cheaper than the average car in the US. So this kind of suggests that, the incremental person that is not buying an electric vehicle maybe just hasn't been reached by messaging and, needs to sort of be informed of all the benefits. So I don't think that advertising is a bad idea. I do think that what didn't get enough focus after the event is this focus on autonomy. I feel like there's a lot of doubt that Tesla can create a fully autonomous car. But the research that we've done suggests that, as Elon Musk said, this will be the greatest asset unlock in history. We think this will be over 2/3 of the enterprise value of the company in the next 5 years, because this is so valuable. And really, it's becoming possible in the next year or so.
Tasha, I think part of the skepticism is not just that Tesla can achieve it, but it's the timeline, right? Like that it's going to do it in the next year. I think that's where a lot of the skepticism comes from. This is an enormously difficult puzzle to unlock. And it's really sort of the last little bit that is the toughest part, because you're talking about real world driving situations. So what makes you so confident that Tesla's going to be able to achieve that in a shorter timeline?
Yeah, I love this question. There's a lot of things that give us confidence. So first I'll say, that I think this might be one of those situations where, Elon mentioned this ChatGPT-like moment that he expects Tesla to have. And I think that, belief might be suspended until it's actually here. But if you're paying close attention and you've watched the updates that they've made to the full self-driving beta program, and actually anecdotally, the user videos that have been generated online show people in San Francisco using a Tesla for a ride-hail ride, an actual Uber ride on their phone. And they essentially don't touch the wheel at all during the drive. At the very beginning and the very end, they do. So I think that we have evidence already that it's basically possible now in select areas, right? It's not perfect. Other items that give us increased confidence are, one, just the plethora of AI progress that we've seen over the past year or so, from large language models like ChatGPT to diffusion models. And we already know that Tesla has incorporated, for instance, transformers, which were popularized by large language models. So I think that this overall progress in AI gives us confidence for the autonomous driving industry as a whole. Now, what makes Tesla so special? Well, Tesla has a different approach to full autonomy than the rest of the players, than Cruise and Waymo. They're going after, this nationwide, possible everywhere approach, as opposed to, using high definition maps and doing a geo-fenced rollout in select cities. The reason that they can do this is because they have an unmatched data advantage. So Tesla vehicles travel over 100 million miles a day. We know that in FSD beta alone, they have cumulative miles of about 200 million so far driven. If you compare that to Cruise and Waymo, which isn't quite apples to apples, I'll note, but what we have from them is that Cruise and Waymo have both passed roughly 1 million miles driven fully autonomously. So, they have orders of magnitude more information about how to solve this problem, and that's what really gives us confidence in their strategy.
Did you hear anything from Elon Musk that would suggest he has confidence that they're going to resolve their 4680 battery issue with Panasonic?
I think that Tesla is really a leader in batteries, and they're at least 3 to 4 years ahead of the competition. So I think that, any fears here are really short-term oriented. We know that they're writing down a battery electronics cost decline curve that really no one else in the industry is. And they're working in-house on, components of the battery production itself and a new chemistry, which actually looks very promising. So I would say overall, the comparison is, what are the traditional automakers doing? And Tesla has much more scale than traditional autos.
I want to ask about the Cybertruck as well, Tasha, because obviously it's been sort of much delayed here. And I always struggle with sort of what the demand is going to be for this thing. I don't know. I mean, admittedly, I'm not like a car person per se, but like it's such a goofy looking thing. I understand it's not all-wheel drive, which is weird to me to have something with truck in the name that's not all-wheel drive. Like, how do we even measure how this thing is actually? And I know there are pre-orders, right? But like, how is this thing really going to do?
Yeah, I think this is one of the the most misunderstood vehicle releases that Tesla has had. I'm going to comment first on the design. This is really a genius design. It's much more cost effective. It's unlike any other car that we've seen out there, and from an aesthetic basis. But really, because they're using just one piece of material, they're not using paint. It's going to be a lot more cost effective and easier to produce for them, because we know that the paint shop is somewhat of a choke point for throughput in an automotive factory. So we think that this vehicle will sell much more than people expect.
Well, wait,
actually,
but what you just said,
Tasha,
if I may, what you just said though has to do with cost. It doesn't have to do with demand in terms of the design, right? Like,
yeah.
So it's cheaper to make. That's great, but people still have to want to buy it.
Yeah. Well, I'm saying that there's a smart reason to choose this design. Now, on the design and the appeal of the car itself, if you look at Google Trends data, we actually see that the people that are sort of Googling Cybertruck and investigating this are overlapping with the exact areas of the country where truck buying is very popular today. So I actually disagree that this will be a car that won't sell that many units. I think that this could, this could be rivaling any other truck out there. Certainly in terms of performance, right? Because again, a Tesla on $1 per performance basis for batteries has, a better metric than any other automaker that's out there. And we know that because of ARC's research. So I think if you look at this versus, for instance, the Ford F-150 electric version, this is a much more attractive car. And I think consumers will realize that. And by the way, I also think they'll use this design on the robotaxi because it is so cost effective. And I think it'll be much more popular than people expect.
What about the all-wheel drive issue, though?
So, I think this is all-wheel drive. Tesla's produced many models before where they have versions with all-wheel drive and without it. So I wouldn't expect that to be a stopping point at all for this vehicle. It might just be that the initial versions don't have it. They add it on later. We've seen that with past models. So frankly, that's not something that I'm concerned about. And again, I just don't think the vehicle is getting enough attention for the genius cost dynamics here, especially when people are commenting that they're worried about demand, price action for electric vehicles. This is a car that allows Tesla to get great margins and to be able to charge attractive prices compared to the competition.
On what kind of time span is it a success or is it a missed opportunity if Tesla is rolling out not just the Cybertruck or able to eventually put the Cybertruck in market, while at the same time the Model 3 perhaps sees even more favorability among consumers that are getting into the EV landscape? On what time span? Because at the same time, you're also going to have the legacy automakers that are ramping up their direct to consumer as well as their dealer fabric and relationship that's been around for decades, a century for some of them.
Yeah, well, I would say actually that the dealer network is a disadvantage for the traditional automakers. I mean, when we heard Elon Musk talk about this last night with pricing, Tesla has a more direct view into pricing than competitors. But also, they have this wildly successful direct-to-consumer model. And with dealers, you actually have to educate them on electric vehicles. And we've seen issues with this in the past, particularly for companies like GM, where the dealers themselves are actually misunderstanding how electric vehicles work, and they're actually including that in the advertising. So I think that's actually a huge advantage for Tesla. In terms of what time frame you should look at this as a success, this is an innovation story at ARK Invest. We have a 5-year investment time horizon. So I think it should be looked at over a over a 5-year time period. But, I'll say with that, again, I think there's far too much focus on this vehicle, the demand for the vehicle. There's not enough focus on autonomy, because when you're talking about 5 years, the midpoint of our estimate, it'll be able to undercut today's ride-hail rides on price. And I think it'll be wildly successful. It'll bring recurring revenue streams and very attractive margins to Tesla, unlike what we've seen in the traditional vehicle business. So I would say that is what you should watch out for over that time period.
I don't want to be the one to make Dara Khosrowshahi say, hold my beer at the end of this conversation. So we will see exactly how that competition plays out in the future, especially on the autonomous ride-hailing side. ARK Invest's Tasha Keeney. Tasha, great to get some of your time here, especially coming after the Elon Musk range of comments that came yesterday. We appreciate it. And coming
Thanks for
up,
having me.
Absolutely. Mr. Wonderful joins us for his take on a busy day. We'll touch on everything from banks to Elon Musk, the aforementioned, and even get his take on remote work. Don't miss it. Tesla shares higher today after Musk seemed to impress investors at the annual shareholder meeting in Austin, Texas on Tuesday. Musk providing updates on the EV business and the heavily anticipated Cybertruck, but he also gave a crowd of investors a tough outlook for the year ahead. Let's take a listen.
This is going to be a challenging 12 months. I want to be sort of realistic about it. that Tesla is not immune to the global economic environment. I expect things to be just at a macroeconomic level difficult for at least the next 12 months. Tesla will get through it and we'll do well, and I think we'll see a lot of companies actually go bankrupt.
For more on Tesla and a number of investment topics, we turn to Kevin O'Leary, O'Leary Ventures Chairman, joining us here in studio. Kevin, great to see you.
Great to be here. Thank you.
So let's discuss. Start with Tesla here first and foremost. I mean, you think about the comments that you just heard from Elon Musk, what he had to say yesterday, and a wide range of topics that he discussed. At the end of the day, this is a company that is investing heavily at the same time that many other automotive companies are investing heavily in their next leg of growth into EVs. What makes Tesla perhaps in a better position to capitalize on where that trend, where that market share that they existingly have right now, or they currently have, could serve them, could benefit this company at a time where they're continuing to invest?
Well, each quarter, including this one, there's always the speculation by the market that competition is going to erode margins. Competition is going to erode share. Competition is going to slow growth. And yet, that has not happened. There is no company yet that's transitioned to the effectiveness and the efficiency and the productivity that Tesla has around drivetrain, around engine, around chipsets, around batteries. Sure. So there's a moat around Tesla because it was, the first mover, but they've maintained their share through innovation. Everybody criticizes this guy for a million different reasons. But at the end of the day, when you ask somebody if you want to buy an EV, what do they want? They want a Tesla. So GM hasn't come with anybody wants. Porsche hasn't done it yet. I'm not saying they won't, but it hasn't happened yet. Meanwhile, they gain share, they reduce price, they're getting more aggressive, they're bringing the truck. I don't see a bad story here, and it's reflected in the stock, although it's a volatile stock. Sure. But if he's saying there's headwinds economically globally, that's the same environment for every company, whether they're in the EV market or not. What they've got that no one else has is 100% focus on EV. They're not dealing with legacy engines of any kind. ICE. Yeah. And so you have a much more efficient use and a much more productive company.
Do you think the Cybertruck is an additive or if I put it simple terms, boom or a bust for Tesla long term?
It's going to be a boom because that crazy looking vehicle has already shown its popularity on pre-orders 2 years ago.
Why?
I want one. I think they're nuts. And I think it would be a lot of fun to drive a tank, because that's what it is. But now a tank where you don't have to feel guilty about it. It's an EV, but it's got a lot of room. It's a very interesting vehicle. It's got a really ugly look. Ugly is interesting. And, to be honest with you, I've got investments in providers that are providing technology for that truck. And we know the demand is huge. It's huge. Now, this issue around four-wheel versus two-wheel, if he comes with a two-wheel first, there'll still be demand for it. Because the truth is, most people don't drive these trucks off-road. But if you wanted to drive that thing off-road, you could. I like it, and I think I'm on the list to get one.
Do you think it'll appeal to the parts of America, or more broadly internationally, where there has already been a strong pickup truck market share that has been maintained?
Well, I love my F-150.
Okay.
And so
you would trade in your F-150?
I don't know yet. I want to try this. And this is a bit of a hybrid on the 150. I use the 150 all the time. It's like driving your living room around. The thing is so spacious and quiet and everything else. And that's the most advanced pickup truck and the most in demand. The electric vehicle of that version has not yet enticed me to switch over yet because of battery concerns, about concerns in cold weather, all kinds of other things. The one thing I really like about the story that I learned yesterday on the whole Elon thing, the margins on this truck could be really high. I mean, this is going to be because they've had so much efficiency in manufacturing costs since they announced the truck. They're probably picking up, 10, 12% more margin on that thing.
And so at a time where consumers also are being more judicious, more discretionary, even about vehicle spends. So how is Tesla and the broader automotive landscape, how is that shaping up in terms of the demand that's actually pulling through, going into either a Tesla storefront or a dealership and saying, yeah, I'm still going to commit to buy, or I'm still going to get favorable enough financing terms that make this purchase make sense?
On the mainstream vehicles, they have cut costs several times now. They're getting competitive. But it's not just because they feel the market is softened. It's because they would like to get more share. Remember, this company, although they've talked about advertising, hasn't spent a cent on it yet. He owns his own global network called Twitter. He's constantly promoting Tesla and SpaceX on it all the time.
Which he has said is a distraction, Twitter.
Well, he's got a new CEO. So I mean, the interesting thing about this guy is the productivity, what he's achieved with all the criticism he gets. Like, he's Batman, that's the way I look at it. And he wants to do what he wants to do. And if you don't, you know what you're getting when you invest in Tesla shares. You know what you're getting when you deal with Elon Musk. It's not like he's hiding it from you. Look, he gets himself in a lot of trouble that must be a big time distraction. All the litigation and all the stuff that he has to deal with by just a non-stop barrage of communications that are sometimes offside. But on the other hand, he is who he is.
Musk said in an interview with CNBC something about remote work that caught up a lot of attention. I want to play this actually, we've got a quick excerpt of it showing for our viewers on screen there too, saying the whole notion of work from home is a bit like the fake Marie Antoinette quote, "Let them eat cake." It's like, really, you're going to work from home and you're going to make everyone else who had made your car come work in the factory. The people that come fix your house, they can't work from home, but you can. Does that seem morally right? Okay, so he goes on. But at the end of the day, it comes back to this broader discussion about who is still able to work from home, and he called some of them the laptop elites, or the laptop class, if you will. We've continued to have this debate about where work from home still has a larger place in the workforce or employment situation society here. Do you agree with what Elon said? Do you believe that there's another way that this can have a balance in the employment future?
I do not agree with him, and I'll tell you why. And he has every right to have an opinion because his sectors are heavily populated with engineers. And you could argue that when you're designing new technology and new products and you're making things and you hire a lot of engineers, as in SpaceX, as in Tesla, you need collaboration at the engineering level as you share ideas person to person. That's one sector of the economy. There's 11 sectors in the S&P. There are millions of companies. And what we've learned, and I invest in all 11 sectors, here's what I've learned post-pandemic. Let me give you financial services, for example. Sure. I have investments in many financial services companies. 40% of the staff, approximately, are never coming back to the office. And if you think you can force them back, they'll just go work for somebody else. And so people in compliance, in logistics, in accounting, that used to live in cubicles in the basement, don't want to do that anymore. They found different lifestyles, sometimes hundreds or thousands of miles away from HQ. And when you now know that 40% don't have to be there, because I've got lots of successful companies that have 40% people working remotely, you can move your headquarters. You can move it out of San Francisco, move it out of New York, move it out of Massachusetts. These are unvestable states. They have terrible tax and regulatory environments. Move them to North Dakota, move them to South Dakota, Montana, Oklahoma. Taxes, way more competitive, regulatory environment better, and we have done that. And I'll give you the challenge that Elon Musk has in his own universe. You can't apply forcing everybody back to work in San Francisco, where Twitter is headquartered. San Francisco is a war zone. It is perhaps the most mismanaged city in the United States, in the most mismanaged state in the United States. You walk out at night, you risk your life there. You get executed. Why would you force somebody to work in a war zone when they could work, particularly on a product like Twitter, anywhere? He will have a very hard time keeping the best and brightest in Twitter saying, you've got to come and go through the war zone every day. If you get shot at, that's not my problem. Do you have a military vest on? Do you have a helmet? Do you have a tank? How are you going to get to work? You leave after sunset, you die. Who would want that? San Francisco is uninvestable and unlivable now. And it's not just me saying that. Look at all the retailers pulling out. The shrinkage is like 10% downtown. People steal stuff, and they know there's nobody going to stop them from doing it. And if you do try and stop them, they shoot you. Well, they've got a lot of work to fix that up on, and that's why working from remote for cities where there are war zones, San Francisco's not the only one. Look at Los Angeles. It's a mess. Poorly managed, changes people's perception. There are thousands of people moving out of New York for tax reasons and safety, 3,000 license plates a month to Florida and Miami region alone.
So thinking through the real estate portion of that equation too. Now, you're talking about major cities with huge commercial real estate footprints. Is commercial real estate, whether directly correlated with the banking stresses that we have seen or based on the favorability of certain cities that you're describing, is commercial real estate one of the next shoes to drop?
It already has dropped. You just haven't seen the effect yet in the banking system, primarily regional banks, because right here in New York is the best petri dish, best test for this theory. You have AAA office, you can lease it out at pretty good prices right now. If you have B-grade office all over Lower Manhattan or wherever, it's just a ghost town. Nobody wants that space anymore. When it used to be packed, that's 40, 50% empty, and it's never going to get full again. They're going to have to recapitalize or reconstitute or repurpose those buildings, and that's going to require a lot of capital. The problem is, why put that capital in a city that is so uncompetitive in the business, regulatory, and tax environment? Move it out of New York. That's the whole idea. And I think, I'm not the only person saying this, I would never invest a dime in New York City. It's got the worst tax policy and regulatory environment. AOC wants to sue you if you try and create jobs here. Look, don't shoot the messenger. These are facts.
Just quick question. I only got 15 seconds here. From the relationships that you've got with companies that you've invested in and the engagements that they've seen with their own customers, whether that be business to business or business to consumer, what type of economic pullback, what type of recession, even shallow, mild, severe, are they foreseeing or anticipating?
This is the crazy thing. I have to spend money on inventory for Q3 and 4 now. I've got to buy that inventory. And I have to guesstimate the slowdown. I have no slowdown yet. And yet I don't want to overspend on inventory. So I'm being cautious and telling my CEOs, pull your horns in a little bit. But what I'm more worried about is that there is no capital available for businesses from 5 to 500 employees anymore. People talk about a slowdown on lending. Let me assure you, there is no lending. And that's because of the Silicon Valley Bank collapse and the other two banks. The smaller banks have stopped lending money.
Kevin, we got to leave things there on the day. Pleasure to have you here in studio with us. Thanks for taking the time as always. Kevin O'Leary joining us here on Yahoo Finance Live. Coming up, paying off credit card debt, what you need to know to get that balance under control here. That's coming up next.
American household debts has surpassed a record $17 trillion this year. Credit card balances totaling more than $900 billion. And this quarter marked the first time in more than 20 years that credit card debt did not decrease, signaling that fewer folks are paying down their balances. This as consumers are increasingly turning to credit cards to make ends meet. A report from TransUnion showing the average American's card balance is up by 14% compared to the year prior. Scott Inman is a financial advisor with Gen Wealth. He joins us now to talk all things credit card debt, sponsored by FlexShares. Thanks for being here. It's astonishing when you look at some of these numbers, Scott. And so it seems as though obviously people are seeing higher prices. They're looking at their household balance sheets in different ways as they are increasing their credit card debt. I guess overall, how should people think about how they should be using credit cards?
Yeah, well, first of all, thanks for having me. There's no question that the current economic environment we're in, with inflation running as hot as it's been for the last 2 years, has caused people to be in more of a pinch than maybe they were before. And I understand that using a credit card may seem like a last resort. It may actually be that. But when it comes to credit card usage, what we tell our clients is it's a two-pronged approach. You have to understand and be educated on how to use them wisely. And it is not a piggy bank. It is not a place to spend money on vacation. It's not a place to buy your next car or the next little toy. It should be a last resort to leave a balance on a credit card. I think the only value really of a credit card is to be able to have a method of payment that gets you points back, rewards points, some kind of loyalty program, so that you have an advantage off of that. I'm not opposed to having a credit card, but you've got to be able to only use it within the context of a monthly budget. And I think that's what we're finding here, is that people are having a hard time paying their expenses within the context of where their income is.
For households that are using, or even individuals that are using credit cards as a bridge right now, for whatever reason in this current environment that they find themselves in, how can they do so effectively in order to make sure that they're able to pay that down later on and not have a huge hits to their own kind of financial structure, if you will?
Yeah, I think if you are carrying a balance and you've had to get there and you do have some debt, you've got to attack that credit card debt. Right now, if you're not able to effectively create a plan to do that in the near term, I think you've got to look at some 0% offers. I mean, they are still out there. You can transfer some of those balances to a 0% interest rate for a period of time. But again, I go back to the word planning here, because that's where we've got to get to, working with a financial advisor and matching the income to expenses and figuring out a way to attack the payments on that. If you switch to a 0% introductory offer, if it's an 18-month offer, you better have a way to make sure you've made those payments and wiped it out in 18 months, because there's obviously a real danger if you don't, because then you're going to effectively accumulate all that interest that you would have been able to defer. So it all comes into the context of planning to have an overall attack on the debt, and credit card debt has to be the first thing you wipe out.
Yeah, it's probably the most insidious as it starts to pile up in terms of the expense of it. Scott, you talked a moment ago about the advantages to having a credit card. Really, the reason to have a credit card is if you're going to get some of those rewards back. What about the idea that it also helps your credit score? Is that a myth? Is that a real thing that that it helps to have a credit card?
I don't think it's a myth. I mean, I think that, when you have a record of debt payment, whether that's through a credit card or through some other loan, and you have a good record of paying that debt, that does actually help your credit score. You don't want to be delinquent, though. You guys mentioned at the top of this segment about the increase in delinquencies on payments, and that's the danger of you don't want to go into, hey, I need a credit card because I want a good credit score, because you could actually end up ruining your credit score because you have too much debt on that credit card. I don't have a problem with having one. I think a lot of places will tell you, look, don't even have a credit card. I don't have a problem with having that, but it's got to be used within a disciplined, planned out approach, or you can get in real trouble.
Scott Inman, who is the financial advisor with Gen Wealth, joining us here today. Thanks so much, Scott. Appreciate it.
Thank you for having me.
Coming up is snacking, and that surge here to stay. We're going to speak to the CEO of Hostess Brands. That's next. Snacks have taken center stage this year, with brands proving pricing power is here to stay. Bank of America estimates that the industry raked in $151 billion in sales last year. Joining us now to discuss the future of snacking. Yes, the future of snacking. We've got Hostess Brands CEO Andy Callahan alongside Yahoo Finance Executive Editor Brian Sozzi. Andy, great to have you here with us today. Let's talk a little bit about this aforementioned future of snacking, because I didn't know that snacking could change so drastically that when you start to think about it in the same context perhaps as the future of work or the future of anything that we discuss, how does the future of snacking look from the Hostess perspective?
Well, at a macro level, consumers have been increasing their snacks and engagement with food for years. The average consumer, nearly 50% of consumers snack 3 times a day. And that's an indulgent snack is increasing at a greater rate than health and wellness or functional snacks. So this is a macro trend that accelerated in the pandemic, and consumers are looking for more contemporary, indulgent snacks that fit their lifestyle. So we have iconic brands, but we're complementing that with new forms. Casbar is a perfect example, but that's been happening for years, and we're there innovating to capture that trend.
Andy, Brian here. Good to see you as always. Of course, you know me, did some extensive research on Hostess by eating a lot of your newer snacks ahead of this segment. And something seems different. They seem more on the go focused. The packaging seems a little different. Who are you focused on with these snackable type new products? And then where else do you have room to play, I guess, in the reinvention of one's lunchbox?
Yeah, at a macro level, we have 2 really terrific brands and businesses. Our Wortman is the leading reduced sugar brand in cookies. Our Hostess brand, obviously our iconic brand, which is nearly 90% of our portfolio, really focuses on indulgent snacks. And you're absolutely right, Brian. We focus on millennial parents and C-store males are 2 really important consumers to us, where we're increasing the percentage of their usage. We're also increasing the amount of times they come back and buy us multiple times. And the way they snack is different. They're looking for not compromising on the indulgence. They want it in smaller bites and convenience. And some of the products you're talking about, whether it's Casbars that we just launched or Bouncers, they fit that bill. They're very convenient. They're very shareable for the millennial parents, and they're more indulgent and potentially larger for a C-store male. We're really focused on them, and our strategy appears to be working.
Does that also, it's Julie here, hi. Are they also higher margin for you guys because they happen to be smaller or just configured differently?
Yeah, well, we enjoy some of the leading gross margins in food, where our gross margins better most, our EBITDA margins actually near the top. And when we innovate, we're focused on that. We never compromise quality. We try to bring consumers the best value. And our philosophy is that over time, all of our innovation is going to be at fleet gross margins or better as we grow. And we're doing a nice job doing that. You know, our single serve business is growing extremely well. Our Wortman business, which is higher margin than our total average, is actually growing at a greater rate. So margins is very important to us, and protecting them is very important to our sustainability.
Andy, I don't know if you saw Target's earnings this morning, but I think they really scared a lot of folks out there with this call out of retail crime. Now, you sell into a lot of these big box stores. I mean, are you seeing customers or these types of crowds come into big box stores and take your goods off the shelves? How do you think about it?
Yeah, you know, we don't experience that as much. You know, we're a very accessible, reasonably priced snacks. I can't claim to be an expert at that. One of the strengths of our business is the breadth of our availability to consumers. We're nearly ubiquitous. We're 10 points higher in distribution than the next nearest sweet baked goods. But our partnerships with our customers are extremely important. So the integrity of our supply chain, our service to our customers, we service them, we work with consumers and share that data and try to partner with them on category growth. Our strategies to grow the category and bring more consumers into snacking is aligned with what our customers want to do. So we have relatively short shelf life. You know, we invest in quality and we're baked goods. So we have relatively short shelf life. So we don't see that issue, but we empathize with our customer and always working to try to solve their problems.
In the future of snacks, how does quality improve? Because I'll be quite frank, I've been extremely critical of a lot of snack problems or a lot of snack products that are currently out on the market, whether it be for the sugar level or whether it just be for whether or not they stay apart or stay together when they're in my hand. How are we improving on the quality of snacks?
You know, quality is probably, after taking care of our team and keeping them safe, quality is our next priority. And being able to bring snack baked goods to ubiquity at scale is not an easy thing to do, and bring that a quality that consumers want is a hard task. We like it that way because we believe, and I believe in our great team does it better than anybody. And we have a really terrific opportunity to bring baked goods combined with the indulgent snacks consumers want in a way that hasn't been done before and at a scale that hasn't been done before. The snacking category is $65 billion. We're a really small part of it, but consumers' ubiquity of love of baked goods is universal. Their love of snacks is universal. And we're trying to bring them in contemporary ways, and we try to do it in a quality way. I said before, I encourage anybody who hasn't had a Twinkie in a while or hasn't tried one of our new snacks in a while, they try them. They're always surprised at the quality of our baked goods. So we invest in that a lot. It's important to us if consumers, regardless of how much discretionary money they have, if they're coming to intersect with our product and they want that joyful indulgence, we want it to be the highest quality experience they can get.
There's been a prioritization of health and wellness coming out of the pandemic as there's this renewed focus on just taking care of yourself. And for that's why snacking has been taking out a lot of people's diets. So how does Hostess look as a brand in an era where people are tracking the Fitfluencers online, they're tracking their own regimens, they're tracking their caloric intake, and if you're like Sazi, you're tracking your macros with every order that you make?
No comment.
What does that look like in that future?
Well, let's get the facts straight. The future is that consumers in a macro level are engaging in snacks more. And they're engaging in indulgent snacks more, but the way they do it is different. The idea that if you eat healthy, you don't enjoy an indulgent snack is a false narrative. Consumers have more snacking occasions, and if they indulge in a sweet snack, they want it to be good. They want it to be portion controlled. They want it to be good. So that's a macro trend that consumers are staying forever, and it can be a small part of a good, balanced, healthy diet. That's the macro trend. This idea of moving from one end of the pendulum to the other, that's not the way young millennial parents and young millennial males think about it. They think about their life, and Dan O'Leary, a great growth officer, articulated that at a recent conference, that's a false choice. The macro trend is consumers snack and eat in balance. And that's what we're trying to be there for. And we want it to be as responsible and indulgent as possible. But the same consumer can eat overall healthy and then try to reward themselves once, twice a week with a great indulgent snacks. And when they do it, I want it to be a great Hostess Casbar, a great Hostess Bouncer, and a great Hostess Iconic Twinkie. And that'd be a great experience for them. And that's what we're focused on.
Maybe the problem is I'm rewarding myself too much. Hostess Brands CEO Andy Callahan, along with Yahoo Finance Executive Editor Brian Sozzi. Thanks so much for the time here. Let's do a quick check of the markets. Absolutely. Let's do a quick check of the market, sponsored by Flex Shares here as we prepare for the next hour. Dow Jones Industrial Average, S&P 500, and the Nasdaq, they're all in positive territory right now.
They are, and Rochelle Okufo has you for the next hour of trading. Stick around.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Okufo. Here's a look at what I'm watching this morning. Target beats the street, but that's not the story here. The outlook is grim. Same-store sales basically flatline, and the consumer is becoming much more selective. So is the resilient spender no more? And debt ceiling negotiations inch forward even as the threat of default continues to hang over the market, particularly bonds. We'll speak with an investment advisor looking to simplify access to treasuries if you still want them. And Elon Musk channels Marie Antoinette as he complains about the work-from-home culture. But is it really morally wrong to have people log in remotely? We'll get into that conversation coming up this hour. But first, let's check in on how the major indices are faring. Positive territory across the board here on that hope of perhaps avoiding some of these debt ceiling problems here. We're looking at the Dow here up about 128 points. Looking at the Dow there also up about 0.4% or 16 points. And the tech-heavy Nasdaq there, the strongest gainer so far this morning, up 0.4% or 53 points. Let's also check in on the Treasury market as well to see how that's faring as we look at the shorter term yields here. The only one in positive territory there, you see, up 0.7% on the day. Meanwhile, the longer term yields, the 10-year down 0.23% and the longer term 30-year yield down 0.4% on the day. Well, so far this week, investors are catching a better glimpse into the consumer as retailers such as Home Depot, Target, and TJX release their latest financial results. Now, given what we've heard thus far, the retail landscape is seeing a bit of a shift on consumer behavior, making for a murky outlook for retailers. Home Depot started off the retail-focused week with a dreary outlook as it slashed its guidance for the full fiscal year, now seeing sales falling 2 to 5%. Meanwhile, retail giant Target also providing lackluster guidance as its second quarter outlook came in below analyst expectations amid a more cautious consumer. And TJX also providing a modest outlook on comparable sales, coming in below estimates as well. However, seeing a bit of a bright spot for the full year in regards to adjusted earnings per share, the retailer raising its guidance, now expecting earnings between $3.39 to $3.48. And while retailers are proceeding with caution amid the changing retail landscape, our next guest says this is the year that TJX will set itself apart from its off-price peers. Here to break this all down and more is BMO Managing Director Simeon Siegel. Thank you so much for joining us this morning. So as we take a look here, you have an outperform rating on TJX. So when you look at some of the value plays in this space, why does this one stand out for you?
Hey, Rochelle, good to see you. So I think what you just went through is fascinating. And I think what's important is to distinguish expectations versus actual growth rates. These are very large businesses that are still growing. So even on that revenue side, you're still seeing that lift. It's not just EPS. And I think that's important to keep in mind. Now, to your point, why this company? TJ is actually a very important and probably underappreciated role within the retail ecosystem. We all know it as the place where we can get deals. But perhaps more importantly, I think the brands know it as a place that they can move a lot of goods and they can do it somewhat invisibly. I like to think that off-price wins because they don't have e-commerce, not in spite of it.
And it's interesting because usually it's the value plays that tend to do well. So when you hear on the call the sort of muted consumer expectations for full year 2024, what should we read into that? And what can TJX do to better position itself?
Sure. And so what's really interesting about TJ is we do perceive it to be value because it offers value. But at the end of the day, you're not getting cheap clothing. You're getting expensive clothing cheap. And so this is a company that's optimizing around value, to use your word, rather than optimizing around price. Other off-pricers there are certain companies that have goals to simply sell things that are $1, things that are $5, things that are $10, and they're very maniacally focused on ensuring that they have a low price. TJ, their entire essence, their identity is to make sure they have a good value. And so that ticket can actually be higher, which actually helps a lot with the trade down that you're referring to. So as people have to pull back their belt or tighten their belt, they're able to then go into TJX and find similar brands at better deals if they're willing to treasure hunt for them. But it also promises this notion of you're not just getting something that's cheap. You are actually getting that brand. So it carries this dual benefit. And I think that's why they're so important for the brands. I think the largest brands in the world can give product to TJX knowing that I can't go and search for it online. That makes it less brand dilutive while still allowing them to sell a lot of units.
And under that umbrella of TJX, it includes TJ Maxx, Marshalls, Home Goods, and some of these other off-price or valued plays as well. But Home Goods are dragged this earnings season. We did get a sort of a hint that that might be the case when Home Depot reported. What do you think is going on in that space?
So I think we all bought a lot of furniture. We all bought a lot of patio furniture. We bought a lot of grills. I think we're still dealing with this consumer over purchase through COVID, where certain categories still need to work their way through the replenishment cycle. I don't think home goods is a bad business. I think it's an excellent business. I don't think home as a category is a bad category. I think it's an excellent category, but I think it's a longer replenishment cycle. And I think if we think about everything that we bought over the last several years, and you think about the fact that that couch is still sitting there, it's going to take time before we do that. So I think that it makes sense that the business is still underperforming, let's say Marmaxx, which is doing really well. But I think an important point to keep in mind is home goods was also the largest margin compressor for this company in the last several years. If you think about everything you and I have been talking about, everything we've heard about in terms of ocean freight containers getting more and more expensive, that hurts someone selling a couch a lot more than it hurts someone selling a sweater. And so I think what was important is we are seeing this margin stabilization. We're actually seeing home goods margin improve. And so there's this interesting dynamic where if home goods improves the top line, if the revenues actually come back this year, that's fantastic. If they don't, as long as the business is stabilized, they're a lower margin business that's weighing on the total less. As home goods becomes a lesser percentage of TJ's total revenues, it actually hurts the margin less. Now, obviously, from a profit dollar perspective, that's a different conversation. But as investors look at the EBIT rate, as they look at the margin opportunity, I think it's an interesting sort of a win-win, whether home goods does well or whether it still just stabilizes where it is.
And we know that you cover a wide range across retail. You've got Traeger. I mean, you've also got Burlington. You get Burlington, Ross, Nordstrom, Lululemon, Ralph Lauren. So as you look at the spectrum here, especially when we look at the performance of Traeger, who would you say are really the biggest winners and losers when you have this sort of retail environment where you see consumer sentiment falling, retail sales not coming in as expected? Who are going to be the standouts here?
So I think TJ will. I think this is a special year for TJ. I think this is real. This is the year where we figure out and realize that they're not just a place that people send their mistakes. They're also a place that people consider as a core part of their full distribution model. But listen, you brought up Traeger. This is another example of a company that likely had an over purchase pattern by consumers that we need to work through. I think it's an excellent brand, but I think it makes sense that we're getting this recalibration. The common denominator when I think about them is which are the items that have fast replenishment. If you have a long replenishment cycle, doesn't mean your business is in trouble. It just means you need to take the time and focus on maintaining that brand equity. But at the end of the day, if you have a fast replenishment, then that's where we're seeing the greatest inflation or we'll call it the least need to promote. And so that's how we're looking at things broadly speaking. The faster your replenishment, the better the pricing power. The longer your replenishment, the worse. I think TJ wins in this current environment and starts to stand out from the way we normally think about off-price as a clearance vehicle to really appreciating the fact that it's a core destination for these brands.
And something else that I wanted to bring up is shrink, some of this inventory loss, not from sales. We saw that come up for Target. Are you seeing it perhaps as drastically, though, in some of the brands that you cover?
Yeah, so TJ called it out last quarter, and it was a pretty material loss. The unfortunate answer is yes. I think figuring out order of magnitude and where it hits worst and who has already told us about it versus not. But shrink is absolutely something that unfortunately I think we all have to account for and consider and hopefully can be fixed.
Well, I do thank you for joining us this morning. BMO Managing Director Simeon Siegel, thank you so much. Well, Tesla's CEO Elon Musk sounded off on a number of topics yesterday in a wide-ranging interview with CNBC. Among them was the topic of work from home. Joining us now with more insight is Yahoo Finance's Diane King Hall. Diane, you knew it wasn't going to be a dull interview.
I know. I mean, this was a wide-ranging interview, quite the interview, I'd say. And during it, Elon Musk derided work from home and called it, quote, morally wrong. Among the statements that stood out, Musk said, quote, I think that the whole notion of work from home is a bit like the fake Marie Antoinette, quote, let them eat cake. He argued that service workers have to be in person, meaning the people building cars or working on homes. Musk also said, this stood out to me, quote, the laptop class is living in la la land. He's also a big believer that people are more productive when they're in person. Now, this kind of commentary, though, calling it, quote, morally wrong, is new to the conversation about work from home. So we put out a poll on Twitter to assess people's thoughts, asking users if they agree or not, or see it as a case-by-case thing. So I want to look at this poll really quickly. I haven't done it yet, Rochelle. I mean, right now it says it's 29% agree with him, 45% don't, 25% say it's a case-by-case issue. Numbers still around that level when I chime in. I'm not going to say where I landed, Rochelle.
I mean, I will say it's one thing to sort of assume everyone in this so-called laptop class is living it up. A lot of people are saving on perhaps childcare costs or can't afford the cost of living in some of these major cities where these companies are. So if not for that, they wouldn't have these opportunities. So a nuanced conversation. So I appreciate why you haven't weighed in on that yet. But also, Diane, Musk's comment, though, the timing. This is coming at a time when more corporations are trying to get people back in the office full time. So what patterns are we seeing there?
I mean, we are certainly seeing more companies sound off about wanting people back in the office. You had BlackRock recently saying saying they want to move to 4 days a week in person again. And they said that's a minimum. So they're targeting September 11th for that date for when they want people back in office. So a lot of the financial firms are doing it, but it's not just the financial firms. You have Amazon, Salesforce, et cetera, wanting more people back in. But this is really a push-pull between employers and employees, because there's some recent data from Scoop Technologies. We're looking at the number of employers requiring workers to be in office full-time, and it actually fell to 42% down. They just put out this week, down from 49% 3 months ago. So, and that lines up with some other recent data tracking people being in office again. So this really is a push-pull between employers and employees. But again, the Elon Musk comment about it being morally wrong, that it was out of left field. We hadn't heard any commentary like that. And I mean, one user on social media on Twitter pointed out, man who sells cars wants us to commute to work. So listen, there is clearly a vested interest there.
I mean, they're not wrong.
Right?
A big thank you. A great breakdown there. Yahoo Finance's Diane Kinghall. Thank you so much. All right, coming up, lawmakers are working to reach a debt ceiling deal. Even so, the market could be in for a rough ride. Just look at 2011. Have that more next. Let's do a quick check of the markets here, sponsored by Flex Shares. All three still in positive territory here. We're seeing some stronger gains. The Dow still up about 124 points there. The S&P 500 there also up about 1/3%. They're being pushed up by consumer discretionary as those retail earnings continue to come in. And the tech-heavy Nasdaq there also to the upside. We are seeing, though, Apple dragging a little bit on the Nasdaq and the Dow. All right, now over to Julie Hyman in our New York studio. Hey, Julie.
Oh, it's a red kind of day, isn't it, Rochelle? Lawmakers say a compromise on the debt ceiling is possible this week, but a deal does not mean the market will emerge unscathed. Just look back to 2011. A serious credit showdown during the Obama administration spurred a U.S. credit rating downgrade that hit treasuries hard. FM Investments is a $5 billion multi-boutique investment advisor based in Washington, D.C. It recently launched a suite of U.S. Treasury ETFs with the goal of simplifying investor access to Treasuries. And with me now is Alex Morris, FM Investments CIO. Thanks for being here.
Thanks for having me.
It is a very interesting time in the Treasury markets. I guess it has been really this year. But let's talk about the debt ceiling specifically, because this is one of the few areas of the market that does seem to be a little bit more reactive to the debt ceiling debate. What do you think we're going to see unfold in the Treasury market?
Well, I think we've seen the 1 month go to levels no one thought it would. And if you look at the yield curve today, it's less of a curve, more of just a bumpy road, which is a good indicator of what's happening in DC. But ultimately, this gets solved. I mean, it happened in the Obama administration. It's happened every time before. The question is, how much damage do we do to the economy or to the Treasury market between now and then? But ultimately, this will find a resolution, whether it's removing the debt ceiling altogether or pushing the limits substantially higher. In the short run, it's like running a money market fund. They say it's 99% boredom and 1% sheer terror. And now we're in that bit where we wonder, God, is this what it comes to? But I think in the short run, we'll see some more rockiness, but ultimately the 1 month will calm down and this will get resolved.
What about the damage, though, that you referred to? You guys recently wrote a paper where you sort of dug into what could be the ramifications.
Yeah, so the short run is, what will we not pay if we can't do this by June 1st? And whether it's June 1st or June 3rd, we have to call it June 1st because politicians need a good deadline. And along that, someone's not going to get paid. I just don't think that's going to be the U.S. bondholder. Ultimately, defaulting on the debt would have substantial ramifications, but some vendors might not get paid. I mean, every few years the government threatens a shutdown and stops paying employees, but then 3 weeks later pays them back. So there's a lot of tools at the disposal that will be used, but I don't think the first reaction is going to be, let's stop paying the bedrock of the U.S. economy, the U.S. Treasury note.
And sort of over the longer term this year, given the dynamics of the Fed, whether it's going to pause or not as of its next meeting, what does the sort of underlying demand for Treasuries continue to look like? We've seen retail enthusiasm that we haven't seen during certainly my investing lifetime as of late. Is that sustainable?
I think for the next year or so, it probably is sustainable. I mean, if you've been investing for a long time and knew the rule of 4%, you're trying to get a 4% yield. And if you can get that from the Treasury markets with no concern for, the next year and a half, why would you not take the free lunch? That said, at some point, rates will come down and duration will be interesting again. And it turns out the average retail investor doesn't do well playing in the middle or long end of the curve. So we'll see some of that demand go back and probably back into equities and growth equities where the returns are much juicier.
Now, I don't know how limited you are in talking about the ETF specifically, but I am curious about an ETF Treasury offering versus, people can do Treasury direct now, right? They can go straight to the US government and buy Treasuries. So what are the sort of various advantages and disadvantages of doing it one way or the other?
Sure. So I encourage anyone who wants to buy from Treasury Direct to go and try. The website's a little buggy, it crashes, and it gives you the full menu of options that the government offers, and it's an awful lot. Whereas, and once you have it, you're going to hold that to maturity. Most folks want to buy something and want to know they can sell it easily for a fair price right away. And that's what the series that we do. So if you take a look at the 90-day, there are a lot of 90-day notes, whether it's a 30-year note that's almost expired, a 1-year note that's 3/4 of the way through its life, or the one issued last Tuesday. What do you want to get? We provide you access to the most liquid one, which is that most recently issued, and that's what TBIL does. You'll get your income, you'll get a monthly income stream as opposed to waiting 90 days to get paid, and if you decide that you have something else you want to invest in, it's just as easy to buy and sell versus waiting or trying to now sell it out of Treasury Direct, which is much more complicated.
Alex, thanks for being here. Interesting stuff, and hope to talk to you again as we see all of the debt ceiling and Fed stuff unfold over the course of the year. Thank you.
Thank you.
Alex Morris is FM Investments CIO. And coming up, betting on the future of artificial intelligence, which companies are the most exposed to AI, will be on the floor of the New York Stock Exchange next.
Here with the latest market moves in today's trading session, we have Yahoo Finance's Remy Blair. Hey, Remy.
Well, U.S. equity markets are holding on to session gains as we head into the noon hour. We're seeing the Dow, S&P 500, as well as the Nasdaq up by over about 0.3%. Now, given that the Nasdaq 100 continues to advance in today's session, that means that that index is higher by over 20% year to date, and that is a considerable advance in comparison to the other indexes. But keep in mind that the gains for the Nasdaq come as we receive better than expected earnings out from some tech names this year, and that is from Apple as well as Microsoft and Alphabet. As for today's trading session, all eyes have been on retailers reporting their latest earnings. We got earnings out from Target as well as TJX, the parent company of TJ Maxx as well as Home Goods. Now, the results out from Target were not quite a bullseye, but this does come at a time as consumers are being careful about where they spend their hard-earned dollars. We saw that Target's profit declined by 5.8% in the latest quarter, and total sales did rise by about 0.5%, and digital sales declined as shoppers cut back on their discretionary spending. Now, in terms of share prices this morning, we are seeing both Target and TJX higher. Now, in terms of the details out from TJX earnings results, it did raise its annual profit forecast, and it is betting on lower costs as well as demand from price-conscious consumers. TJX is seeing expenses come down, and the company is now expecting its 2024 adjusted profit to come in above its previous range. It has also maintained its full year's sales forecast. Looking ahead, we will be getting retail earnings out from big names, including Walmart as well as Lowe's. And last but not least, very quickly taking a look at Tesla shares, they are higher this morning. Now, Elon Musk did forecast a challenging year ahead for the car maker due to higher interest rates affecting purchases by consumers. The CEO of Tesla did say that 2 new Tesla models were coming, and also, most interestingly, Musk told company shareholders that the company will advertise for the first time in history.
Yeah, that's an interesting one. Wasn't expecting that advertising angle that he mentioned there. Fantastic stuff. Remy Blair there from the floor of the NYSE. Thank you so much. Well, artificial intelligence was in the spotlight yesterday as a hearing including OpenAI CEO Sam Altman dove into regulation surrounding the growing technology. Congress made one thing clear: they have learned from prior mistakes with social media. Yahoo Finance's Dan Howley joins us now. We did hear that comparison quite a lot there, Dan.
Yeah, that's right, Rochelle. Throughout the hearing, we had Senator Klobuchar, Senator Blumenthal, basically talking about how when social media was on the rise, they didn't do enough to try to regulate it. They kind of focused on Section 230, that's part of the Communications Decency Act, essentially the legal shield that allows companies to dodge liability for content that they host that's posted by other users. They said they allowed that to basically guide what was going on with social media. And so they missed the boat on how to regulate it. It just got too big, too fast, and went past where they had the ability to go in and write new legislation. So they're trying then to keep up with AI. Unfortunately, while the hearing yesterday with OpenAI CEO Sam Altman was informative, and while there was no acrimonious back and forth between him and the senators, in fact, it was actually very constructive. A lot of different interesting question and answers from the collected senators. There's no real move forward plan at this point. Senator Blumenthal basically saying that this was the first of several hearings that they're going to host on AI. The problem is the technology now is just moving so fast that while the likes of Altman and Google CEO Sundar Pichai are saying that they want some kind of regulation, Mark Zuckerberg in the past, Meta had called for regulation of both social media and AI. It just doesn't look like they're going to be able to do it fast enough to perhaps catch the direction that AI is going. So, while they do say that they want this to happen, it doesn't look like it's going to happen anytime soon. And just with social media, that could prove to be a problem down the line as AI continues to evolve and moves into more and more industries.
Indeed, and despite that concern, still seeing all the companies you mentioned pushing forward and releasing new things in AI. Also want to shift to Microsoft's bid for Activision Blizzard. The UK shut down the deal, but then regulators in the EU approved it. So then what does this mean for the company overall?
Yeah, it's kind of a confusing place now where we have the likes of Japan, the EU saying you can move forward with this deal. Microsoft can acquire Activision Blizzard for that $70 billion and, start to become a larger player in the gaming space. Meanwhile, you have the UK as well as the US with the FTC basically saying, no, we don't want this deal to happen. The Microsoft, Activision Blizzard can appeal those. They can fight the lawsuit that the FTC has brought. They can appeal the decision by the Competition and Markets Authority in the UK. If they are able to show in the US that the EU is correct in its ruling and that, look, we have these guarantees, we're going to work with Sony, we're going to work with Nintendo, with NVIDIA. We already have deals in place with Nintendo and NVIDIA where we'll provide Call of Duty, that's the game that they're all talking about, with 10 years of content. Then perhaps the FTC can say, okay, or a judge can say, okay, you're satisfying the concerns that the FTC has there. If that happens, then what happens in the UK? Well, if Activision Blizzard and Microsoft can't appeal or lose the appeal there, some of the experts I spoke to say they might just carve out the UK on its own, set up a secondary business where they'll just operate as they do now, separate entities. And on the global scale, you would have Microsoft and Activision being able to offer their services as one. So you would have basically what Microsoft wants to do is make its cloud gaming platform the best in the world. Frankly, it is right now as far as offerings go and capabilities. And then they'll be able to grow in the mobile gaming space, another part that a lot of people aren't talking about, but an important piece of this discussion. Now, they would be able to do that everywhere else in the world. People would be able to play games on their smartphones that they otherwise wouldn't be able to do because of cloud gaming. And then the UK would just be left kind of in the dust. And perhaps down the line that would change. But it looks like if they are able to go forward in the US, then the UK will just be left behind.
I mean, it does seem like that will be the case, especially if the US follows the EU suit. The UK will be there like Billy No Mates, no friends. Eventually, I think they will come around, but I guess we'll have to see. Dan Howley, thank you so much. All right, coming up, On Running was responsible for one of yesterday's market head scratchers. Blowout numbers, EPS beating the street by a mile, a raised forecast. Then the stock slumped. It's down again today, as you can see there, by about 6.5%. We'll ask the leadership what's going on next. World Health Organization called for caution in using artificial intelligence for public healthcare, warning against bias and misinformation in using AI. But where exactly does AI currently stand in healthcare, and what does the road ahead look like? Here to break it all down for us is Yahoo Finance's Anjali Khemlani. Anjali, a lot of people had questions about where this could be heading.
Well, we definitely know that the possibilities are endless, but the way I like to say it is that if AI were a human, it would be in college, or at least getting there, thanks to ChatGPT. But in healthcare, there are many areas in AI where it's still basically in daycare. Biotech and medtech are the most advanced right now, with things like machine learning being used for imaging, think x-rays and CAT scans, and then medical devices, so monitoring patients and giving push alerts for when patients need attention. And then lastly, in drug discovery, the most prominent examples of that we've seen in the recent past include Moderna's use of AWS to determine its COVID vaccine formula, and Google launching drug discovery and precision medicine tools for cloud. But even in all these use cases, an adult still has to check the machine's homework. The hope is that one day AI can streamline healthcare. We can already see some of the potential there with companies like Digital Diagnostics, for example, which is an FDA-authorized company that can diagnose an eye disease in patients. Then there's Mass General Cancer Center's AI tool, Sybil, which can detect early signs of lung cancer. There are also tools that are doing the same in breast cancer and brain cancer. And then there are other tools that are working to assist doctors in communicating with patients. A new study showed actually that ChatGPT is more detailed and empathetic than a human doctor, so that's interesting to watch. And then other areas like suggesting therapies and treatment plans based on similar patient data, like we've seen with the U method, which can help create treatment plans for Alzheimer's patients. But relying solely on AI for these uses is a little bit farther off in the distance. One of the biggest hurdles in all this is the siloed way that each sector of healthcare operates. So we know that data stays in the hands of companies or organizations. And so within all of this, that's where some of the hurdles stay. In addition, we know that there's also limitations with the guardrails that are going to be coming up. So tinkering and experimenting with all these is just one way to look at it. Now, we also know that the FDA is one of those. The guardrails that need to be put in, they're currently working on those, but there isn't a concrete market right now for them to wrap the regulations around. And so experts are still wanting humans heavily involved. And it's something we heard from lawmakers as well as experts at the OpenAI hearing yesterday. NYU professor Gary Marcus had this to say.
I think medical misinformation is something to really worry about. We have systems that hallucinate things. They're going to hallucinate medical advice. Some of the advice they'll give is good, some of it's bad. We need really tight regulation around that.
So just like for every other part of it, we know that there are regulations that are still needed and that it's basically all told a long road ahead. Rochelle?
Indeed. I mean, an incredible tool, though, considering where things could go. Anjali Khemlani, thank you for that breakdown. Right, well, running full steam ahead. Popular Swiss running brand On Holding started the fiscal year with another record-setting performance. The company posted record revenue, a whopping 80% increase in sneaker sales, and boosted its full-year guidance. Despite all that, inventory continues to be a problem for the company, and shares are falling sharply for the second day in a row. Let's bring in On Running's co-CEOs, Martin Hoffman and Mark Mora. Thank you so much for joining me this morning. I mean, talk about what we're seeing with the share price today. Martin, I want to start with you because, I mean, people were celebrating this, but now we're seeing some selling action today. What do you think investors are honing in on?
Well, we're celebrating as well, and we're very proud of the quarter. 80% growth. We have been growing very strongly in all the different regions. 90% growth in Americas, 50% growth in Europe, almost 100% growth in Asia Pacific. We significantly increased profitability over last year with 14.5% EBITDA margin. So we raised our guidance again. We continue seeing very strong demand. So we are super proud, and we are here for the long term. And this is what we are building the business for. And I think Q1 was a very strong proof point for what we are doing.
And Mark, what do you think about the inventory concerns that some of these analysts are honing in on?
Yeah, I think we have two elements at play here. One is we're trying to build inventory, fresh inventory that allows us to overachieve also, the potential targets that we set out. So we want to be able to capture that demand. So we're very happy with that. And then the other one is over the last couple of months, We've been accelerating how we get inventory, so the factories have been able to ship much faster. Transit lanes on the freight side have become faster. So there's a bit of a catch-up happening here from COVID. But it's fresh inventory, it's new inventory that allows us to capture demand, and we're not worried about the position at all.
And we see there that you've got some of the clothing as well as the sneakers there in front as well. Talk about some of the best sellers here, because I mean, you did see some success here across the brand for some of these.
Yeah, I mean, on the shoe side, we just launched the Cloud Surfer, so here in front of me, which is the first shoe on our new outsole technology, Cloud Tech Face. So fully computer engineered, really soft, smooth landing and takeoff. And it's doing well. It's been the strongest launch of a product that we had. And then also on the apparel side, we just launched a lot of really strong items, both for the dedicated runner, but also for people who like to move in our apparel. We see the success in our London store, for example, that has been an amazing start since the opening in February. And already there, apparel makes almost 15% of the sales in that store.
And Mark, obviously for a lot of these international brands, we've seen, some of these foreign exchange headwinds showing up, having an impact on gross margins. What are your expectations there? Because we did see that you noted a 60 to 100 basis point impact on the gross margin.
Yeah, so we see still a relatively weak euro compared to pre-IPO when we set our long-term goal. For us, important is that the fundament of the business is in the right place. So the cost of the product is there, our channel mix is there, we are selling full price. So again, we are here for the long term, and the business is set up to reach that 60% gross profit margin.
And I know you say you focused on, the seasoned runner, looking at Hellen Obiri's win at the Boston Marathon in particular. When you have a shoe like that in the spotlight at such a big event, what about broadening it out, though, to perhaps, your non-traditional runner, or perhaps people who like to wear them more for fashion? Any plans to expand there?
Yeah, we're very happy about Hellen's win. We also had several victories, for example, in Milrose Games and track and field events. Very much looking forward to the Budapest World Champs. We also signed Iga Swiatek and Ben Shelton on the tennis side. So I think we're proving that our products are really, really strong, and they're resonating on the very high-end peak performance side. And we want to make that accessible to all our fans. So the product that Hellen has run will become available to our consumers. We're making the tennis shoes available. We've already launched the Roger Pro. And this is really trickling down. And that, as Martin already mentioned, this allows us to have the biggest launch ever with a product like the Cloud Surfer. So we're innovating on the top high-end side of the running range, but also make it very accessible for the people that want to run 5 miles, 10 miles a week.
And Martin, one of the key themes that we continue to hear across this earnings season is the role of AI. How is your company sort of incorporating it both on the customer experience side and perhaps what it does in terms of efficiencies for the business?
So the mission of the company is to ignite the human spirit through movement. So what we want to do is we want that people move, and this is what we are here for. This is what we are creating the product for. But there are many opportunities to work with AI to make processes more efficient. And there are probably also opportunities towards the customer to make that movement more enjoyable. So we are looking into that, but our focus is really on the innovation in the product, what you experience on your feet and on your body.
I'll definitely have to check those out. A big thank you there to On Holding co-CEOs Martin Hoffmann and Mark Maurer. Thank you so much for joining us on Yahoo Finance.
Thank you so much for having us. Thank you.
All right, coming up, we'll break down the biggest takeaways of earnings season for the streamers. That's next. The earnings season has wound down for the streamers. And now we're taking a look back at the biggest themes that we've seen this quarter. For that, we bring in Yahoo Finance's Alexandra Canal with her 3 biggest takeaways. What have you got, Ali?
Hi, Rochelle. Well, you're right. This was a very important earnings season, sets us up for the back half of the year. I do have 3 takeaways, and the first one I want to start with is advertising, because the ad market, it's still a serious problem. We're in the middle of upfronts this week. That's been overshadowed by the ongoing writer's strike. But despite the confidence in a lot of these major studios over the demand for advertising, we have heard on various earnings calls that it's still a problem, that slowdown really eating into margins, eating into revenue targets. There is optimism that perhaps in the back half of this year, we will start to see some relief, that perhaps this is cyclical, but right now that's still an ongoing issue, and management did admit that on the call. The second thing I want to call out is we have seen improvements when it comes to direct-to-consumer profitability. Warner Brothers Discovery reporting a streaming profit for the very first time. Paramount Global also seeing sequential improvement. Netflix beating expectations. However, subscriber slowdowns really started to take effect this quarter. Netflix shares took a hit after they reported a miss. Disney stock seeing its worst decline in 6 months after that company missed targets. And for me, that was interesting to see the investor story play out there, because we know profitability has been very important to shareholders, but perhaps how fast a lot of these media companies are showing declines in that subscriber growth, that's spooking investors a little bit, especially since that brings me to my third point. Price hikes are on the horizon here. We have heard that Disney is looking at its price structure. Paramount confirming that price hikes will hit later this year. We have the Netflix password sharing crackdown, and that's in the face of a lot of other restructuring efforts. There's been mass layoffs. There's been companies that have shut down certain organizations and divisions and comboed that with other units of the business. And that's all in hope that these efforts will bear fruit down the line, that they will improve profitability, improve revenue, and that these companies are on track to hit their targets. That remains to be seen. I think a big thing to watch heading into the back half of the year is content. We have heard from a lot of these companies that they're going to be really strategic in how they approach content and that content spend. So perhaps as a consumer, you're going to be paying more for less product down the line. So overall, I'd give this a lukewarm earnings season. Not too great, not too poor, but I think we're really going to start to see some answers towards the end of 2023.
So then I'm trying to see here some of the upside for the consumer then. If you might not be going to be getting these sort of big budget, content-wise, and then you're also going to have to be paying more. And this is coming at a time where we're already seeing consumers pulling back on spending. What does this mean for some of these streamers then? Is the timing just a little bit off, you think?
I think it means consolidation is on the horizon, right? I think it's obvious that not all of these companies are going to survive this tumultuous period, because as you said, the consumer, they're going to start to be a little choosy. We've already seen that play out in those subscriber declines. So I do think that consolidation is coming. I think in 2024 and 2025, we're going to see a lot of M&A activity in this space, but we'll have to wait and see how this all plays out. But for now, I think all of these companies are just trying to be the number one choice here. They're trying to create a sort of value proposition. That's why you're seeing a lot of ad-supported offerings to try and lure in that consumer that might not want to pay as much on that ad-free tier, but there's still a TBD factor on how effective that will be down the line.
Indeed, we all sort of pulled the plug because we thought it'd be cheaper than cable, yet here we are sort of paying more for all of these individual streaming services. Oh well, great stuff there. Thank you for that, Ali Canal there for us. All right, taking a look at shares of Disney, since we're speaking of streamers, we're seeing that it's trading to the upside here, up about 1.33%. It's a busy time for the Magic Kingdom. Disney execs are taking part in a media investor conference today. They showed off their brand to advertisers in their upfront presentation on Tuesday. Now, streaming giants are pushing back against a tough macroeconomic environment that has them cutting costs to push profitability. Consumers are dealing with subscription fatigue and higher prices as the media giants battle it out for dominance. So what is currently setting Disney apart from the rest? Well, for more on this, we turn to Ivan Feinseth, Tigress Financial Partners Chief Investment Officer. Good to have you on the show here. We know that you are a Disney bull here. So give us your base case in how you think Disney is faring and how it's going to set itself apart right now.
Simple. Content is king, and Disney is the king of content. And it's the power of their content that has driven this dramatic rise in subscribers from the initial 0 when they launched in November of 19 to surpassing Netflix across the combination of all their subscription services. And it's about the power of their content. And then Disney is best positioned to benefit further from the power of their content. It drives park visits, product licensing, and all of the other services and products that they sell.
And we've got a couple of the brands up there as well. There was a heavy focus, especially on sports. We saw them rolling out a lot of ESPN celebrities at upfronts. Talk about that big shift that we saw, because we didn't see a lot of actors at the upfronts, but we did see this huge showing from some of the sports brands.
Well, I mean, live sports is a powerful driver of viewership because you want to see it live. You want to engage in it live. And then they also have great commentary shows that involve further engagement and also online engagement. So they have, I think, the industry's best content and the industry's best platforms for it. They also have a big push on local news, which really connects with people and then drives further interaction onto their platform. So I think just on all fronts, Disney has such a powerful presence and incredible technology that's behind what they do. And I think the stock is incredibly cheap. And if you listen to the earnings call last week, certainly the parks are strong, cruises were a bright spot, and all of the Disney engagement just continues to drive further Disney engagement.
So I want to ask you about content, because we did see, a lot of reality stars. We saw Kim Kardashian, Ryan Seacrest at these upfronts. Not a lot of actors. You also have, of course, the writer's strike and concerns about that as well. How much of that is going to factor into some of the cost cutting and strategic spending for Disney?
Well, the writer's strike is going to have an issue. I think it gets resolved relatively soon, but they did show a lot of content. They didn't have the actors there, but they have a show, featuring the second season of a show featuring Samuel L. Jackson as Nick Fury. They have the second season of Loki. They have a lot of fan favorites and the power of The Mandalorian and Disney that has driven the launch of other shows that they, including Obi-Wan and Andor. So they have a lot of powerful content that has strong fan bases. So I think that will continue. And I was very impressed with the lineup that they have. And I really love Disney content personally as well.
And I have to ask you about advertising, obviously an issue that a lot of streamers are facing with. And then, of course, Disney has also the linear TV aspect as well. But Disney ad sales chief Rita Ferro said, quote, "The advertising business is at the doorstep of a massive transformation." What is Disney going to have to do to really get more market share when it comes to ad spend, as people are being more strategic here?
Well, I mean, digital advertising spending does provide advertisers with the best ROI, and it's measurable ROI. So, and it's the ability to, laser target the potential customers that they want. And I think those are all powerful drivers. And you're going to continue to see increasing spending on digital-based advertising. And it's not going to believe it's going to really slow down. And I think it will pick up significantly.
And we've been talking about Disney Plus and it used to be the fight over subscribers, and then it's the fight over content as well. How well positioned is Disney versus some of the other players in this space when you look at, say, a Netflix or an Amazon Prime as well?
Well, I think there is great content across all of the streaming services, but I think that Disney has the best content and the broadest content and connects with its fan base in multiple levels. And again, they are best positioned to benefit from the halo effect of their content. And I think that's the real power of their content.
And it's interesting because we talked about the news space as well and saw them honing in on live local news. When you look at what's happening with the media landscape, what do you think of that move? And really, what is Disney planning in terms of how this fits into the broader landscape when you look at, say, a Twitter or some of these other ways that, people are really consuming news and media differently?
Well, there's no just one platform. Everybody uses multiple platforms. But I mean, local news is a powerful engagement tool for people because everything is local to an individual. So I think that's important. Sports, everybody has their favorite teams, especially in college sports. They have a big presence in college sports. So I think that they have it going on in almost every aspect. Now, profitability is important, and they have invested a ton in content, and they will continue to do so. And they recently indicated about the need to optimize their content, which I believe means focusing more on shows that have the bigger viewership base and less on shows maybe that are less popular, and hone their content, which every business does. But I still say that they are best positioned to benefit from the content they have, and they have the best content.
And certainly when you take a look at that content and all the different spin-offs available, certainly a lot of endless possibilities there for Disney. A big thank you there
So
to
much so.
Ivan Feinseth of Tigris Financial Partners. Absolutely. Thank you so much for joining me this morning. All right, well, executives at the eye of the storm when the U.S. banking system collapsed are on Capitol Hill today. They're addressing the House Financial Services Committee. Former SVB CEO Greg Becker reiterated that SVB's collapse occurred due to a series of, quote, unprecedented events. First Republic CEO Michael Roffler also speaking, he blamed that collapse on contagion in the aftermath of the failure of SVB. There was no doubt collateral damage. $100 billion worth of deposits were withdrawn from the banks in the weeks that followed. Now, Roffler added that no regulator expressed concerns over the bank's liquidity, something certainly to keep in mind. All right, let's do a final check of the markets as we head into the noon hour. Take a look at all green still across the board at the moment here. Some of that buying action picking back up, but we're still seeing a lot of hyper oscillation across the board here. The Dow here up about 186 points, or about 0.5% here. The S&P 500 also up about 0.5%. Similar situation here for the Nasdaq as well, up about 65 points on the day. And as we see there, consumer discretionary had been doing well, hence the boost in the S&P. That does it for now. I'm Rochelle Akufa. I'll be back with you at 11 a.m. Eastern. See you then.